So let me start by thanking you all for coming. Every year we produce a whole load of different reports of brand finance. This one is triggered by our global intangible finance tracker, which I think we've been doing for in excess of 20 years, where we basically get data from all the world's stock markets, look at the value of all the companies on those stock markets, and compare it with the booked capital that is in their published accounts. And we look at the difference between the tangible assets that are in their balance sheet, the intangibles that have been booked as a result of accounting of acquisition transactions, and look at the goodwill. And we nearly always find that about half the value of the companies on the world stock markets are unaccounted for, which we call unexplained intangible value. And we've been raising that subject year after year after year, attached to the idea of lobbying for better reporting so people understand the intangibles. It's quite an interesting campaign. We say more or less the same thing every year. This is ridiculous. Why isn't there better reporting? And every year there's a bit of a discussion about it, and then nothing seems to happen. I think things are beginning to happen, and Annie is going to talk about that later on. So that was what prompted this. I was told to do a bit of an introduction for anyone who doesn't know about brand finance. We were set up in 1996, so we're over 25 years old now. We're in over 25 countries. Several of them are subsidiaries with, between half a dozen and a dozen people. A lot are just representation, but we work very actively around the world. I think about 95% of our turnover comes from outside the UK. So it's a weird thing that when I set it up, 100% was in the UK, and now it's almost 100% not in the UK. And we're kind of sitting there going, yeah, maybe we ought to get a bit more business in the UK. So that's part of the reason that we're doing this event, to say hello to everyone. We have always tried to bridge the gap between marketing and finance. When I set the company up, I thought it was a proposition that would be fairly rapidly dealt with and everyone would realise that it was an obvious thing to do. But here we are more than 25 years later, we still have the same old problems where marketing and innovation people and design people find it very hard to understand and get a sensible hearing out of finance people, and frequently, the result is dysfunctional. So there is still plenty of room for us. We don't sell any executional work, we just give advice to both sides, and we have a team of people, there's now 100 worldwide, mixture of accountants, lawyers, licensing people, market researchers in particular, and we try to be technically credible by participating in all these various different learned bodies like the International Valuation Standards Council and so on. We try very hard to push forward the discipline of brand valuation, intangible valuation, the way it's reported and so on. You've got to start with a quote about something. And so I asked Annie to dig one out from Warren Buffett, because we all know that Warren Buffett loves companies with great brands like Coca-Cola, McDonald's, Goldman Sachs. I thought I didn't realise he'd said it this way. I thought he just said he liked moats to keep the baddies out. I didn't know he'd actually said he wants sharks in the moat. Does that mean we're sharks helping to defend that moat? I don't know. Hope not. But anyway, it goes to show that the best investors do actually understand and put a lot of money behind intangible assets. And I just wanted to say thank you very much to the London Stock Exchange for hosting us today. I also want to thank Tata Consultancy Services for sponsoring and being a partner in the event. So thank you to both of you. It's been great that you've helped facilitate this. And later on, we're going to hear from Ashish Babu, who's going to give us his view on technology, whereas some of the earlier speeches are about more kind of tangible businesses with a brand involved. What I wanted to say, though, was that the London Stock Exchange has been, subject to a lot of press coverage about the challenges to the London Stock Exchange, but just wanted to say that in our table of the most valuable stock exchange brands in the world, the London Stock Exchange is the most valuable and strongest brand in Europe amongst stock exchanges. You can see that it's heavily dominated by the States. So a lot of the debate about people deciding not to quote here and go over to the States, in a way you can sort of see America is really the home of mass capitalism. And I thought this might be of interest for you to see. You can see here, following that argument about tangible versus intangible value, what we have done is we've added up the balance sheets of all the companies in those different stock markets to try and work out which one is the most intangible. And you can see there that the OTCQB clearly doesn't have a brand person involved. I had to ask where it was, actually. It's New York, apparently. So the over-the-counter market in New York is the one with the highest intangible value of any stock market when you look at the companies quoted there. But you can see that, strangely, both AIM, which slightly surprised me, and the London Stock Exchange are quite low down the table. There are something in the order of 200 stock markets worldwide. I think there's about 50 in our table, and they come about halfway down the list. Now, I was talking to Annie about it, and it's a bit of an irony in a way that Britain is a great place for developing intellectual property, all forms of intellectual property, including brands, and yet weirdly our stock market doesn't reflect that. And it's obviously one of the challenges as it is trying to get market share from the other stock markets in the world. But hopefully we'll hear a bit more of that later on from the horse's mouth. So I just wanted to say, this is the kind of thing that the London Stock Exchange is trying to deal with at the moment. Various people getting quoted in other markets, competitive market for our IPOs. Where do we go from here? Part of that is to do with governmental action to make London a more attractive place. Hopefully they will do as many things as possible to make London the place where people should be putting their intellectual property on the market. So we have 3 speeches talking about the difficulty and the challenges and the issues around raising finance. Annie and I have been doing this thing on reporting year after year after year, and she will talk about that after the break with a couple of relevant institutional speakers. But we kind of decided that the reason you need to have better reporting is because it helps to raise finance, and that is a real issue for people who are trying to develop the brands and the IP. So I thought, well, let's hear it straight from the horse's mouth. So we've actually got 3 speakers. The first talking about financing seed capital, and that's going to be about the British Design Fund, which a good friend of ours, John Mathers from Cornwall, introduced me to Brandon. Brandon is going to talk about it and go through Damon is going to talk about it. Sorry, I'm getting confused between Brandon and Damon. Damon is going to talk about that. Damon and John are in partnership with the British Design Fund, which gets people on the road. And I was very struck by the fact that they said they've made about 50 investments, and so far none of them have gone bust. None of them have been realised, but none of them have gone bust, which I think is a pretty major achievement. And they're now raising the next big fund, which they will talk about. We then have Damon, who is going to talk about... Sorry. Brandon. Sorry. Apologies. We're then going to have Brandon, who's going to talk about the big black box, which apparently wants to be the IMAX of immersive experiential venues, which is a very interesting concept. And they've got some amazing shows lined up, but they're struggling to try and get finance to make it all work. And then finally, we've got Oliver, who's going to talk about Fever Tree. Oliver Winters started off at FT Consultants, where he was doing financial PR, and he helped to float Fever Tree on the market in 2014. So he's seen it all the way through. They poached him, and he now works in-house. So he can talk us about the whole issue of later stage capital. So I think those 3 speakers will be tremendously interesting. I'll call them up one at a time. We hear the speech, and then afterwards we'll have about 15, 20 minutes of questions, which I hope you will ask the questions, not me. So, I'm trying to get through this fast. Oh, I think I've slightly overrun already. Okay, our first speaker.
Thanks, David. Morning, everyone. So my name is Damon. So co-founder, as David mentioned, and CEO of the British Design Fund. So what do we do? Very briefly, we're quite uniquely placed in that we exclusively invest in very early stage, so pre-revenue, manufacturing design businesses. So these are, let's say, technology businesses based in the UK that have developed a solution to a compelling need, a kind of very real problem. And to take that through to market, they need to engage in some form of manufacturing. They're not themselves typically the manufacturer, they're often contracted out, but there is an element of go-to market which involves hardware, let's say. So all of us around the fund, John has already been mentioned. John's from the creative space and design and brand space. Myself, I'm a manufacturing entrepreneur, and all the founding team around it. We're all let's say, operators, very comfortable with hardware, very comfortable with manufacturing, comfortable with early stage, and that's effectively why we set it up. And this little statistic here, so we didn't have this when we set the fund up. We had a I suppose a gut sense that there was something like this going on, but we didn't have the research to back it up. That bottom bit, the zero funds, it's basically zero funds focused exclusively on early stage hardware businesses, let's say in the UK. But so it was at the Design Council where John, our chair, was CEO at the time that we, a bunch of us got together. We were helping hardware, let's say inventors with their ideas, very, very early stage. And we were giving them some useful advice about go-to-market, about financing and all these sort of things. Which went down well, but they'd all come back to us effectively and say, this is great, but we have no one that will talk to us about funding. Because we've got some hardware as our solution, we can't find investors that really understand it, that will take us seriously. They just want to do kind of software or kind of platform stuff. So effectively, and in terms of time, so we are effectively still a startup, really, I suppose. The first fund launched 4 years ago. We've done 5 funds to date, but it was about 6-7 years ago that the kind of penny dropped for the sort of 3 of us that got together and set the thing up initially. So what I'm going to do today, I'm going to talk to you about how we, at the very, very early and arguably the riskiest stage of a brand's life, right? It's not even really had any life put into it yet, and arguably not much value put into it at that stage. And just to clarify, so the companies that come to us that we invest in, they are typically pre-revenue. They'll have IP, and that's something we do value. So we look at the kind of patents and things like that. They will have a brand. Let's say they'll have an identity, but you could argue, and we do. We very, very rarely consider that as part of a justification for evaluation that they're putting maybe towards us or when we negotiate with them. But there is an identity, let's say, and there's a brand coming together. But very often in the first year or 2 of their life, that brand will change, it will adapt as they go out into market and they have their first few skirmishes. They'll come back, kind of lick the wounds and reposition themselves maybe. So kind of quite rightly, we don't look at it at that moment in time and ascribe a large amount of value to it. In some cases, there is some value ascribed if they have, if it's, for instance, a consumer brand and there's maybe a strong following already, kind of pre-launch, but it's a bit unusual for us. The brands up here are the brands we've backed so far, and a lot of them are kind of, a lot of them are quite engineering-led. They don't typically have an awareness before they launch. So what do we do? And that's what I want to talk about today very briefly, is kind of as early-stage investors into British brands, British product brands, but how do we ascribe value when we're making our decisions, and how do we make our decisions when we're trying to pick the winners to back? So I mentioned already, so IP is a big part, and that is, and obviously we look for trademarks. When companies come to us, we do expect there to be a brand story, and I'll touch upon that in a moment, because that really does help at the point of exits, and as the brand grows and they're raising funding. But at the very start, we'll be looking at IP around really patents, maybe registered designs. We'll be looking. We will expect them to have some kind of trademark and domains already bought to sort of defend the brand that they're presenting to us at that time. But we'll look at the credibility of the team. There's a lot of really, really kind of, I guess, further kind of intangibles. Really, we're kind of questioning those teams as they go through our selection process, and trying to figure out if they got the kind of the winning formula. Are they coachable? Are they listening to us in those first few engagements we have with them? And as they come into pitch and bring their technologies with them into the kind of the pitch days we run, do we kind of believe in them? Are they telling a compelling story, and does everything line up? Other things that will help in terms of when we're looking at kind of how they position themselves. Do they understand that competitive set? How uniquely placed are they? And does the IP, and this is a kind of important one, the IP for us at this stage being really the sort of the patents and things, does the IP defend that unique positioning they've got? Because you often find companies will kind of, how do you say it, sort of shoehorn a bit of IP in there because it sort of sounds good for the investors, but it's almost not, it doesn't create a defensible position. And obviously things, and a lot of other things that really are, that any early stage investor would look for. So, attractiveness of market, so not just, and then looking at the other players in the marketplace, not just in terms of, how uniquely placed are they, but how are those competitors going to react when they discover there's a brand kind of nipping at their heels. So yeah, and just I said I'd mention like our view on the brand, and I'm going to touch on it again just before I finish. But at the stage that we deploy money into these businesses, and they've gone through our due diligence, our commercial review, and we've had experts come in and give their opinions. When we're effectively buying into a story, and a lot of that story is that brand. Can we see, even if they're really, and a lot of our businesses are pretty unsexy engineering B2B businesses that do very strange things that most people would never really think about in a day-to-day life, but we still see there's a place for that brand. To give return to our investors, we see it can give us, I don't know, 1.5% or so bump maybe in the multiplier at exit, but also on that journey to exit, there are so many sharks swimming around in the moat. Not all of them sharks that we've employed, and that brand piece can help stave off some of those. If you can very, very quickly shortcut through to, defensible positions within the marketplace that don't necessarily need a team of super expensive lawyers to defend you, like they do ward off to a certain degree and give you a little bit more breathing space. So it's not just, we don't just look at it as a multiplier at the point of exit. It's like along that journey, how can that help them? So I'm very quickly going to show you a few. So it's not 50, we're not quite at 50 yet. We've got 30, and they're all doing really well. We haven't had failures today. Part of that is probably that we're quite unique. So our deal flow that comes in, we can be very selective, but also we deploy experts and mentors into each of these businesses, and I think that kind of makes a huge difference to them. I just want to talk a few and sort of. So these all came to us as pre-revenue. And some of them, I think there's 3 examples here, so I think 1 or 2 of them still are technically pre-revenue. We'll talk about how their brand developed. So Koala, that's a disruptive prosthetics brand. So they've kind of turned the prosthetics on its head by making a sort of soft wearable prosthetic you can basically fit yourself. You don't need to necessarily go to a clinic. It's about 10 times cheaper than most of the alternatives. You can have it on your limb within 40 times quicker, typically, than any of the other ones that need measuring and fitting. And how did they? So we invested in them, I think it's just over 2 years ago, but they very successfully established their brand. And again, with very little budget, just all of these companies, we fund them, and they usually have some grant money, but they're not sat on large amounts of cash. But these guys very successfully established their brand. They are the UK's most worn prosthetic for children under the age of 6. That's how they kind of got famous, let's say, and that's how we often think about our startups. They don't have the budget to be present in every channel. So what can we do to kind of make them famous? So they worked with charities very successfully, sort of NGOs, and also direct-to-consumer campaigns, and successfully got the brand out there very, very quickly. So by the end of the second year of us being involved, they'd achieved that with the brand. So that's obviously put them in good stead. Didn't cost them a huge amount of money, but already you can ascribe value. These guys, so these again, about the same time we invested in these. They've developed a bunch of ex-Dyson guys, developed the world's most effective filtration technology to capture microparticles. So the problem they spotted was all of this waste coming out of our washing machines when we wash our clothes is a big source of pollutant. But what they've ended up in, so the challenge, so they're kind of pre-market. They've got revenues, but it's more non-recurring engineering stuff with big brands. But they've got a retrofit solution you can see here that is a typical consumer product. It will sit next to your existing machine and work on it, and that's got its own brand, Gulp. But the business is called Matter, and the technology is Matter. They have an inside offering, kind of like an Intel Inside type thing, which they license to the big players, and then they have industrial programs to go into sort of big textile factories. So the challenge, so that brings a challenge. And so what we're working with them on is how can they have synergy across all these different solutions and markets, and what kind of silver thread can they have running through it all, so that every time there's a touch point with one of the technologies, it's this technology powered by Matter, let's say. So that's a brand challenge that we have to overcome, and not an unusual one. And then lastly, this company, White Motorcycle, set up by a couple of ex-Formula One engineers. Effectively, the middle pit, they put a Venturi duct through the centre of bikes. Basically, they modify the chassis, retrofit them onto existing bikes. So they don't want to become a bike brand in themselves, which again poses that other kind of challenge, which is how do we help them build a brand in a space where really they've got 3 different routes, 3 different kind of, I guess, solutions and routes to market, but all of them really work with OEMs, so existing bike brands like Yamaha and etc. So how do we make sure that they're not only delivering an amazing technology that the OEMs love, but also at that point of exit, their brand, they're not just being stuffed inside a chassis and everyone forgetting about them. They're actually building up a brand that we can kind of leverage at the point of exit. So again, both the last two pre-revenue, so we are working with them on those sort of strategies, but it's the sort of thing that we have to think about. And then just to start wrapping up, so some of the I guess say tactics that we deploy with our startups. So part of the mentoring programs often work around, look, you don't have tons of money, you don't have massive budgets, but we need to establish your credibility, build your brand, and all these things are good for defensibility. So I picked 4 that we pretty much work on with all of them following investment. So we aim to, within 12 months, get product market fit and get them revenues. That's a huge point of difference. You're suddenly a brand that means something to a customer. You've proven market fit. You'll have learned a huge amount along the way as well, but you're on your way. You can argue your brand now is starting to really gain some value. The third point, domain authority. We do this with most of them. We try and come up with kind of content strategy, content and marketing strategies, let's say, for the founders and the brands on how we can kind of shortcut them as quickly as possible to become a domain expert. So Faisal on here. So Faisal, we've invested in Faisal's business a couple of months ago. It's the world's first flat pack kind of thermal water heating solution for off-grid solutions. So what we do is say, Faisal, is how can we get you and Solaris Kit, the brand, to be the go-to place for, say, commentary in and around the topic of thermal heating, water heating off grid, let's say. So we'll pick 2 or 3 remits, and it works really well. Certainly when you're on a cash-strapped budget and resources, although you don't have a huge amount of human resource to throw at it. And we sort of deploy those content strategies, things like LinkedIn, other social channels, get them speaker slots, get them commentary on BBC, all the usual sort of thing. And then following that, we aim to very quickly, if we can do what we say we like to do, get them trading within 12, 18 months. Then we get them follow-on funding, and then and often you'll see a rebrand at that point, but they then start that growth journey. The curve starts picking up. And just to finish up, so we're a startup ourselves, really. We only started, the first fund was 4 years ago. We've done 5 funds now. And how do we do what we did? We basically we walk what we talk to our companies. So we've managed to punch above our weight by deploying kind of clever content strategies and being very, very switched on with our marketing and our consistent messaging, after identifying the space we want to play in. The great thing about that as a fund, that means that we attract good quality deal flow. So the inbound inquiries we get, the opportunities that we review are of a larger number, and we can be more selective. But also it attracts best-in-class kind of leadership. So people like Sir John Rose, it's on our investment committee, and people of that ilk that invest in the fund and join us. That's phenomenal. We couldn't do that if we didn't kind of shortcut our way to building our brand up. We've maintained that clear differentiation. We are the only early stage fund in the UK that backs early stage hardware exclusively, and all of these things have kind of, as I'm sure we'll hear later on today, all of these things, some of these kind of intangible bits all start to create a momentum. And that momentum for us has meant our portfolio performs very well because of that whole funnel. We're quite selective in the support and the amazing team we have around with us. But if you break it all down, you couldn't do any of those in isolation. It all comes together from building our brand up. Yeah, and we're now in a position, because of that, we can continue to expand our funds under management. We can go slightly later stage and slightly wider in the engineering firms that we back. So yes, thank you very much.
Hello, everybody. I'm Brandon. Quick background on me. This is going to be a slightly different presentation than perhaps you're expecting. We're going to poke a little bit of fun at the investment market with this. I appreciate that the kind of helpful things here are just to give some recommendations on fundraising at different stages, but this is a little bit of a little bit different here. So a quick background on me. I'm originally from Silicon Valley. I had a career in tech for a while before coming over to London in 2003 to get an MBA from London Business School. I ran Arcadia's e-commerce division after London Business School and started a burrito chain called Tortilla, which you may be familiar with, which is now at 87 sites. And we IPO'd actually in this building in 2001. And as part of that, I was asked to be an operating partner at a private equity firm called Trispan. So it's a hospitality investment firm. They own Roses, Faux, Mowgli, and a couple other different businesses. And as part of that, I've had the benefit of seeing a lot of different business models in hospitality and also being able to form a view on what's going on in the property world, because obviously property is really key to what's going on. And probably my biggest observation with everything that's taking place in the world, and there's a lot of kind of crazy change, both pre and post-COVID, is that technology has disrupted every asset class on the high street. So if you start to think about it, department stores impacted by e-commerce, cinemas impacted by streaming video, pubs impacted by social media. You don't really need to go to a pub to catch up with your friends anymore. You can do that on WhatsApp, Facebook, Instagram. Everybody knows what's going on. And also, you don't really want to just go and have a conversation. You want to have a shared experience, competitive socializing like swingers and flight club. Those have come in. Those have kind of replaced what pubs are doing. We saw a frightening stat the other day. In 2003, there were 144,000 pubs in the UK. There's now 99,000. We just dropped below 100,000 for the first time. But the things that are booming are social leisure. Now, it's not really a property asset class, but you can just see immersive experiences, competitive socializing, those are all flying. Now, I want to touch on a couple of those different property assets first. I'm going to stay away from offices and hotels for the sake of this discussion and focus on department stores and cinemas. David talked about moats. Think about the moats that exist. If you can come up with an OpCo, an operating vehicle that can take advantage of what's going on in the department store world and the cinema world, if you can take over one of those property asset classes, that would create a solution. The current usage is in decline. There's high repurposing costs for the landlords. That's a really key one. If you're going to repurpose a department store, every landlord that I've spoken with that has a department store, I've spoken with about, I've looked at about 20 different department stores. They all say it's 15 to 20 million pounds. What if you could create something that just takes that department store and operates it almost like a department store of experiences, right? Limited conversion uses. Who's going to take over a department store? Who's going to take over a cinema? There's really nothing to take over a cinema. It's such a bespoke piece of property, right? It's made for a cinema and previously made for a theater. And then restrictions from local councils around planning conversion. Think about the cinemas. The local councils don't want you to change the cinema. They don't have enough cultural aspects as it is, and they're going to really ring fence that stuff. That is a moat for them. And so the challenges with repurposing this are huge, and landlords are in trouble as a result of that. The result of that, though, if you can get, so the fact is that suitable higher sales density opportunities exist, and they benefit because of the landlord paying from low rents, huge capital contributions, the idea that there's nothing really to take these sites, there's no replacement usage, and a global opportunity. Everything we're talking about here is a global problem. And the fact is that there are solutions that exist. There's a brand called Supernature. So Supernature is a department store of experiences. It's an all-day hangout. Think of it as a public Soho house. You can actually use the department store as it is. You don't have to chunk it up. You don't have to put in multiple different retail spaces. You just use it in its existing infrastructure. Cinemas, Big Black Box, which we're going to talk about today. Tarek and Tim, who are co-founders of Big Black Box, are here today. IMAX of Global Touring Exhibitions and Immersive Experiences. I'm going to park this for a second because we have a couple slides that we'll be able to talk about in a second on that. There's a concept called Boondoggle, which was started by the founder of Vagabond Wine. So he started self-service wine. Beer is even bigger. Self-service beer. That would bring down labor costs, which would allow you to make the model that exists now with pubs work. And Mazar, which was started by the founder of Street Feast. So if you know Dinorama and Dalston Yard, he's rebooting that as Street Feast 2.0. Meanwhile uses. There's no real solution for meanwhile uses. At least there's no brand for it, and he's created a brand for that. Now, what's interesting about those kind of solutions are there are other OpCos in the market that exist to take advantage of particular property asset classes. So car parks, Reef raised $1 billion from SoftBank to take over car parks and replace them with Amazon distribution centers, dark kitchens, and other services. So basically an arbitrage, taking advantage of £4 a square foot rents. High street retail shops. Souk has put together a concept where they put surround sound, if you will, but surround video across all these different units. And in the morning, you can operate it as a yoga studio. In the afternoon, you can operate it as a product launch place. And in the evening, you can do an art exhibition. So micro leasing. TVG Hospitality are taking over music venues, and there is a replacement for department stores aside from Supernature, and that's Gravity. Gravity is focused on family entertainment centers. They're using the same infrastructure as it exists. They don't have to really repurpose it. Enabling costs are low. They benefit from incredible rents, and so amazing model. But it's very hard to get into these spaces, and we'll come into that in just a bit. So just a bit on Big Black Box and the opportunity with them. There has been an absolute explosion in the US on global touring exhibitions and immersive experiences. Some of those have come over here, but not many, because they can't find any property. Jurassic World came over. They did incredibly well at Excel. They had a space in Vegas, and they sold 1 million tickets the first year. You may know the Haigh exhibition, if you haven't been to it, in Lightroom in King's Cross. Incredible. They were selling 2,000 tickets a day at their peak. These are booming, and what you're going to see is an omnichannel approach with the film folks, the music folks, the heritage folks, and somebody else. Which else? And music. To where there's IP is going to, every IP is going to have some kind of exhibition associated with it. And there's ones that we're very excited about that we're under NDA, we can't even describe, but this is all starting to pick up. In the States, there's not really a problem in terms of getting locations because there's so much land. They can take brownfield spaces, they can put up a temporary structure, everybody's driving, and so it's easy to get to it. Here, you can't really put them in a stadium or arena, they're too big. Museums are incredibly expensive. Retail isn't the right configuration. Exhibition centers, Excel is way outside. Theaters, conference centers, none of them are quite right. But there is a couple of different property assets that are perfect this. Warehouses could work, bingo halls, retail, possibly. But what are we going to do with cinemas? What are we going to do in terms of repurposing the high street and making sure the cinemas work? What we're really talking about here is, think about the background on cinemas. They really were theaters before. So theaters existed, and then suddenly someone came up with motion picture, and that replaced the theaters with a one-wall screen. Now we've got a 6-wall screen, and that's it. And so that's the natural evolution while everybody's sitting at home watching Netflix being streamed to their home. Why do we really need to go to the cinemas? Big Black Box is looking to create 16 sites across Europe where we somebody comes over, they put it into London, we bring it over to Paris, we bring it over to Berlin, we bring it over to Madrid, et cetera, and we take it on a tour with minimal downtime, and we are a one-stop shop for being able to take that across Europe. They've signed a first site, Sony Center Berlin. Well, I should say, we're in legals on Sony Center Berlin. So this is the former IMAX at the Sony Center Berlin at Potsdamer Platz, an unbelievable venue. 35,000 square feet. It's got 5 cinema rooms. There's going to be 2 different exhibitions going on simultaneously, and it's going to be kind of bonkers. Founders, progenitors of this idea, I should say, are Terex. So Terex ran Venue Lab, so all the events that you may have attended at Battersea Power Station or Printworks over the last decade, that was Terex. Also ran 10 other venues as part of Venue Lab. And Tim, who's a veteran in the entertainment industry, Tim has managed all kinds of folks. I don't want to embarrass him because he's managed brand name artists that we've all listened to, probably on Spotify. And Laura, who has worked with Tim, to work with Tarek previously. Amazing advisory team, all-star team. Now think about, that's kind of the Big Black Box side of things. Let's come back to the property asset issue. Think about the prize if you are Big Black Box or any of these other property asset class, opcos that can take advantage of property asset classes that have been disrupted by technology. If you get to be a big box unit, if you are taking on that kind of asset, think about what happens with the landlord. I've battled on the high street against Pret and Itsu and Wasabi and all these guys trying to take 100-pound a square foot venues with no capital contribution for many, many years as part of Tortilla. When you get into the big box world, the landlord just pays for just about everything. You think about hotels, often those are management agreements. The landlord pays for it. Co-working, co-working is a straightforward Cat A fit out, 125 to 150 pounds a square foot is financed by the landlord. Members Club, Soho House doesn't pay for their stuff anymore. In fact, when somebody pays, so the landlord will pay for the fit out, and then anything on the upside in terms of valuation, Soho House gets 25% of that. They share in the uplift in the valuation of the assets. Food halls, Timeout Market, not a management agreement despite what everybody says. It's actually a franchise, and the landlord pays for everything. And big box retail, Fraser Group is now asking for 7-year rent freeze in some cases. So the prize, if you can create a new big box OpCo is gigantic. Not really financeable. Why? Well, it's hard to get a site in the first case because we're at cross purposes. So the landlords want comparables in the market. They want existing use classes. And they want that because then there's some other hotels that they already know a valuation on and they can understand what the yield is. So there's a marketplace for it. And they want low yields because valuation is inversely related to yield, and that would maximize the valuation. What are we doing as entrepreneurs? We're trying to find gaps in the market. We want no comparables. We want no competition. They want tons of competition. We want none. And by their very nature, we're not going to have a big balance sheet. We're going to have a small balance sheet because it's a new co, because it's an entry into the market. So they're looking for the Debitums and the Wilcos of the world, established uses, really big balance sheets. We're looking for gaps in the market with small balance sheets. And as a result, it's incredibly difficult to get a property. And that is why the high street remains as it is, because the property guys don't have the guts to actually invest and allow the new wave of stuff to come through that could actually revitalize the high street. There's also an investment challenge. So think about these big box units. They are not small CapEx. They are big CapEx. If you're starting a burrito shop in Islington, £435,000, raised from 40 people, 10 grand a piece, no problem. If you're raising £5 million for a first site to take over the Sony Center in Berlin, that is a big undertaking. You're not going to get it from a couple of random friends. It's not friends and family. It's institutional backers. And institutional backers for the venture capital community, too big a check, right? £5 million, no proof, too big a check. For the seed round, private equity, not far enough along in the business life cycle, right? They need to see one. Just come back when you have one site. We'd love to invest. Property investors, they need a property asset. And it's so interesting because the property investors should be the ones doing that. We're giving them a vehicle with which to invest if they'd invested in OpCo that would allow them to then gobble up cinemas, department stores, and other distressed assets and revitalize those and benefit from it because the performance on these are way better than their existing usage. But they need that property asset class. They have to tick the box on that because limited partners require that they do that. And at the moment, sadly, it's left to the family offices and they are just on the sideline. They are not investing at the moment because it's tricky out there. So what we have is a property world that was predicated on yields and valuation methodologies that didn't anticipate that there could ever be something so crazy as technology to disrupt it and create additional channels that render it not obsolete, but flawed at a minimum. And we have a gap in the market for those that are willing to put in large amounts of capital in a seed round to finance this stuff, a double whammy. And that is why, that is the only thing that's holding back the evolution of the high street. Now, so solutions on high street exist, quick summary. Rewards would be huge. Existing property valuation methodologies are outdated and institutional investors seem unable to get away from tick box exercises. I'm an operating partner at a private equity firm. I'm watching that tick box exercise go on every day. It frustrates me. Now, but here's another challenge. And this is where a class of, a forum of British audience listening to an American probably says, please F off. But I need to remind everybody of something here. The UK is at the bottom of the G7 in private sector investment. Here's us. I say us because I'm a British citizen now. We're at the bottom. We have a set of investors that are way too conservative, probably just getting management fees and sitting back. Not only that, we're 27th out of 30th in the OECD in private investment. We are not investing in this country. It's too conservative. So I leave you with this idea. Yeah. And that's it for me.
Morning, everyone. I'm Ollie Winters. I'm Director of Communications and ESG at Fevertree. I'm sadly not one of the co-founders, but I have been, first of all, as David said, advising the business from around 2014 when the business was going through its IPO phase, which I'll come on to. And since 2017, I've been in-house as Director of Communications, ESG, starting off also on the IR side before that has got a far bigger beast, which again, I'll tap into. So I'm here today, as David said, to talk about the challenges and opportunities for brands at the latter stage of their financing requirements. So I won't be talking about too much of this sort of early seed funding and family office that Fever-Tree had from 2003 up to 2012. My focus will be more on 2013 onwards. But if you will indulge me, I'll just sort of go back to the sort of founding of Fever-Tree, because I think it's important to provide some context around Fever-Tree. Hopefully, some of you would have sampled the products in the past, but probably some of you might not know the founding story. So it was actually launched in 2005 by Charles Rolls and Tim Warrilow. Came out of a first meeting of the two of them in 2003. Charles had been very successful in taking ownership of Plymouth Gin, revitalising that and selling that in 1999 to Absolute. Tim at the time was looking to set up a gin business. He had noticed the boom in craft gins and was interested in FMCG, had an itch to become an entrepreneur, so was keen to leave his advertising job. Had been given Charles's number by a mutual colleague. They met for a coffee in Orioles in Sloane Square in 2003. And at that very first meeting, their attention quickly turned from gin to tonic. Charles had noticed when he was going around with Plymouth Gin that every time he was trying to tell everyone the wonderful qualities of Plymouth, obviously gin you mix with tonic, every time that was happening, it was being doused in some fairly average mixtures, so we say, which basically destroyed the flavours and aroma of his Plymouth Gin. So that got him incredibly frustrated. Tim had also noticed the explosion in craft spirits at the time, most notably gin with the likes of Hendrick's and Bombay Sapphire. And like I said, at that first meeting, they both thought it was extraordinary that if 3/4 of your gin and tonic, I mean, some of you might have it slightly stronger, but usually if 3/4 of your gin and tonic is the mixer, why shouldn't that same care and attention be given to the mixer rather than just the gin? So they then and there vowed to have a look at the mixer category. Obviously, it was dominated at the time by one very large multinational company from the other side of the Atlantic, who had basically cost engineered a lot of the quality and ingredients out of it over the last preceding 15 to 20 years. So there was a dominant player. It thought it had a very big moat. People thought that Tim and Charles were mad trying to go after them. But actually one of their early investors said at the time, what do you mean there's only one competitor? You know, they sort of looked at it the different way and went, wow, there's a real opportunity here. But they realized to create something different, they'd have to create something with the highest quality ingredients, but really the highest quality packaging, you know, put quality back into the whole category. And that's in the glass, the glassware, the serve and everything else. But nowhere more importantly than, like I said, the ingredients themselves. So they went back into the history books, 2003 to 5. They investigated the history of tonic water, history of mixers, went to the British Library and found that the highest quality quinine, which is the main ingredient in tonic water, it gives it that very bitter taste, came from the cinchona tree. And that the highest quality plantation was in the border of the DRC and Rwandan area. So Tim went out, got on a plane to Kigali, got a plane across the Rwanda, got a taxi across the border to the DRC, met with the producers who were producing this medicinal grade quinine, and to this day they are still our sole producer of our quinine. So that is a philosophy that's been kept right up till this day. We go around the world sourcing the very best ingredients we can. We distill them at source. So, you know, it's fantastic. We get gingers from places like the Ivory Coast. I was in Cochin in India earlier this year seeing our ginger producers. So it's something that's really set us apart and still remains the philosophy we have. At the same time, what the category had was completely devoid of any choice. Consumers at one very early focus group, Tim and Charles weren't big fans of focus groups. They still aren't to this day, but they did one focus group very early on, and a lady said, you know, she said, I sleepwalk my way through this category. You know, all the way around supermarkets, I'm confronted with choice everywhere I go, but I turn down the mixer aisle, all I see is PET, large format, own one brand or own label. There's no choice. So again, they were very quick to realise, actually, to recognise that with spirits increasing, with gin increasing in its flavours, its aromas, you know, these wonderful gins coming on board, that it was an opportunity to create a portfolio of tonics. So they very quickly rolled out a number of different tonics alongside their premium Indian one. And this still is our most visited page on our website with our pairing wheel to tell people how to mix, you know, the perfect gins and tonics. But what's exciting is it's not just tonic, it's not just gin. You know, this the rise of premium spirits is accelerating more and more. Beer and wine, is on the decline. Certainly wine is sort of fairly flat. Beer has been declining across the world. Premium spirits, are becoming increasingly drunk by the younger generation who are looking for longer, lighter drinks. The spirits companies are suddenly getting onto this and realizing, actually, if my tequila that used to be drunk once at night at 12 p.m. probably as a shot being handed to me as the last drink of the night, my holy grail here is that tequila needs to be drunk, at lunchtime, at sporting events, in the afternoon, at bottomless brunches. And they realize the way to do that is to get it drunk long and mixed. So therefore, we work with all the biggest spirits companies around the world to get their serves in the right places, drunk by the right people. So we have a growing portfolio of brands, portfolio of products, to match with things like tequila, which often people say, oof, but believe me, try Paloma with our sparkling pink grapefruit. That will convert you to tequila. Aperitifs, vermouths, Campari. We've obviously all seen Aperol Spritz, but there are many other wonderful drinks like that, and of course vodkas. But alongside that, it's whiskey and rums. Again, whiskey has a reputation of being drunk by the fire with a wet dog by your side at about 11 p.m. Single malt. I'm sure there are still people here who would probably curse to think that whiskey should be mixed, but in America, bourbon's huge, huge, huge opportunity. So, our gingers go incredibly well with them. The mules in America, Kentucky mule, Jalisco mule, all of the above. Dark and stormies with rums. Probably too early to talk about this too much, but it kind of gets you thirsty. But I think what I'm trying to say is, the opportunity for the business is growing and growing. We are now about 360 people. Starting with 2 people back in 2003. We are the number 1 mixed brand in the UK, the number 1 tonic and ginger beer brand in the US. We have offices in Germany, UK, America, and Australia, and distributed in over 90 markets. It's a very quick summary because I want to sort of provide context on that. Probably the slide we're most proud of is this. It's the UK mixer category, value share, both on and off trade. So back in 2014, that little yellow line, we had under 5% of the mixer category at the time of our IPO. Schweppes is sitting up there pretty happy with life at around 60%. Over that time, you can see we've now overtook them in 2017-18, and alongside that, the category is nearly doubled in size. So I think a lot of that's down to the brand, a lot of it's down to the marketing. People do accuse us of just being a very clever marketing company. Trust me, there's a lot more that goes into it than just that. We've added value into the category, which is integral to the on and off trade, and it's something that we're still very keen to continue growing. So I think I want to sort of jump to that point in 2014 because this was the point that the business, 2013-14, 16 million turnover. We were in 40 markets. I think that's an interesting case study for another day, how Tim and Charles went out very early before they'd even really touched the UK, recognised the advantage of the need for first mover advantage with a premium product. You need to get into countries quickly, plant your flag. So they went off very early and went around the world to sort of sell Fever-Tree. So already by 2013, they were in 40 markets with 8 products, a small consolidated supply chain, again, all outsourced manufacturing, still with those partners today. 12 staff. I wasn't one of them there, but I can see at least of those 12, 7 of those are still working at Fever-Tree, which is great. We're now, like I said, 360. One office just off the King's Road in London, and a finance team of 2. So, a pretty daunting place to then be told, we are moving from our family office who had been very supportive partners of the business for 6 years, the business had been growing incredibly well, announced in 2012-13 that they wanted to exit, recoup their investment. So this kicked off a rather fraught process for the very small management team and very new CFO, Andy, in terms of what to do next. They had a lot of PE businesses interested in the brand and the business, but it took a lot of time and effort to sort of go through the pitch process. And I think Tim and Charles would admit at that time they probably took their eye off the ball slightly in terms of driving sales. It was a small team. There was a lot of their time was taken up with due diligence on the brand, answering questions and everything else. So for that 1 year with sales didn't increase as much as they would like. But what it did do, as they would admit, it made them focus from a sales orientated to a more complete organisation in terms of doing due diligence on yourself. You know, what's key man insurance? What supply continuity measures do you have in place? You know, actually, are we a bigger grown-up business? Are we ready for this next stage? So I think it was invaluable for them at that time, the sort of 2013 private equity round. They chose to go with LDC, who made their investment in 2012-13. But when they came on board, Tim and Charles were very keen to reiterate that they sort of knew what they were doing. They felt they knew what they were doing. I think they had a pretty good sort of track record over those years. So they weren't looking for too much front office support, but what they did need was support around the corporate governance, the back office stuff. And LDC were very happy to let them run the business, get back to doing what they do, get on those planes, go and meet distributors, go and sell the product, go around the world, continue to drive the opportunity. But while LDC brought in, you know, their expertise around corporate governance, you know, in the middle there, I've kind of, you know, listed some of the things that happened at that time. That for the business with a finance team of 2 and a sales team of 10 and 2 owners was a pretty scary prospect. But it was invaluable time for them. But also at that time, Tim and Charles were already looking at the next stage. You know, they understood the advantage of having PE and the advantage of what they did, but they also knew the risk in terms of, you know, PE are great people, as we know, but they can look to, you know, to flip their investments in a pretty quick, especially if it's a very well-performing business. So Tim and Charles knew the risk that in 2 or 3 years, they could be going through that whole process again. They could be, you know, slipping control could be slipping from them. They could be kind of in this sort of slight cycle of continue looking for new owners. So they were very open with LDC that the next stage for them was a float. You know, that was the wish. LDC were very supportive of that. So actually, within 6 months of LDC owning it, there was already a plan to potentially look at kind of if the finances kept going the right way, that they would look to IPO. So that decision was taken early 2014. This opened up a whole new world for Tim and Charles, whole new language, things like pilot fishing, things like IFRS, you know, these things that really, again, was a whole new world for them. And, you know, I think I can come on to kind of the life of the listed company, but the thing that Tim and Charles would say is, you know, you get inundated with new information, you get inundated with advice. But the important thing is to kind of cut your way through it, find the right advisors who can really support you in that. They held a beauty parade. They chose Investec as the brokers at the time. You know, it gave them a banking advice. It gave them a great analyst, but it also gave them a great sales team who understood the business, who helped put together the story. And I think, you know, it was a very successful process. Within 6 months, the business floated in November 2014. There's them just through there. At that time, I think the valuation was 155 million. So I think it was a pretty good turnaround for LDC, a pretty good investment for them, and everyone seemed pretty happy. It was obviously quite a lot of money was taken off the table, but it did leave money in there to drive the next stage of growth. Because, you know, that money, that platform as a listed business, you know, came at a key time. So Andy would say the next 2 or 3 years was about building the team. It wasn't about finding particularly specialists. Maybe it was generalists who could then fit in a small business, understood the entrepreneurial nature of the business. So it wasn't about finding the CVs. I think sometimes mistakes business can fall into, I know we have in the past, is be slightly blown away by CVs that come from people from big business, and they come into a small entrepreneurial driven business and expect to have 20 people around them to do their work, expect to have their own office and everything else. I'm not saying there's anything wrong with that when the structure's there, but for us at the time, that wasn't what we were looking for. They were looking for people who understood how the Fever-Tree worked. So they built the team. The funds gave them the opportunity to diversify the supply chain, diversify the risk. We now have 7 or 8 bottlers around the world. You know, drive supply negotiations. You know, and also I think the key thing was invest in the growth. I think that was what Invested wanted, and that's what the business continued to do. That first mover advantage was there. The opportunity remained huge. So we opened our US office in 2018. We switched from a distributor model there to take ownership of the operations. And I think the other 2 key things, really, innovation. We continue to innovate. The funding gave us the opportunity to do that. It gave us the opportunity to invest in larger scale marketing activities, TV advertising. 2018-19, we sponsored the Queen's Tennis Tournament for 3 years. You know, it was a real kind of sort of step change in the business. You know, you can waste a lot of money doing things if you don't do them right, but we recognised what we needed to do. So, you know, that decision to IPO was one that was, I think very, very important for the business. But life as a listed company doesn't just mean you can take the money and run. There are quite a few requirements of it, and it shouldn't be underestimated in terms of the time it can take. AIM was deliberately chosen because of that slightly lighter touch. They didn't want to get into a death spiral of financial reporting regulation as a small business. AIM has given them that flexibility, but there is a huge amount of engagement that goes on with investors. We've been incredibly lucky to have a fantastic supportive investor base, long-term shareholders who understand it. There are other shareholders who claim they're long-term. Not so much. Their long-term is 3 to 6 months when you're thinking 3 to 6 years. Obviously, they claim they're longer term, but they flip out pretty quickly. Analyst engagement, sell side, I won't go into the huge detail. We now have 22 analysts covering us. It involves a huge amount of time. Their forecast and what they think we're going to do is what we're beholden to. We obviously started off as that share price went up by managing expectations as well with 2 or 3 analysts, under-promising, over-delivering. It's got slightly rockier since then, not all of it within our control, but there is a huge amount of work that has to go on behind the scenes. ESG considerations is incredibly important. We remain very focused on that. So, it's been a fun journey, but it hasn't been without its trials and tribulations. But I think the thing that Tim and Charles would also say at the time, 2014, was they've never been afraid to court publicity. On the left, you'll see early kind of PR opportunities for them. They weren't afraid to stick themselves in wheelbarrows on the back of bikes, on the back of everything, dress up in can things, the launch of our cans. But they realised that being a listed company, being a brand, being a consumer-facing brand as a listed company gave you a fantastic platform to drive awareness with investors, but those investors were often your consumers as well. So, they have been very focused on driving PR, much to that's why I'm probably losing some of my hair, the stress of that, but it's a great opportunity to really, to help tell the story. The media can be fantastic advocates, fantastic supporters of British brands. So the journey's been from that early startup, taking on that Goliath, trying to take on Schweppes, through to the IPO itself, through to now refocusing. People obviously still view us as a UK tonic company. We do see ourselves as a global drinks brand. A pretty successful one at that. So it's now about refocusing the attention from that UK opportunity, which is still there, but really focusing on that global opportunity as well. So, but at the same time, as the right-hand side shows, journalists do like a pun. They like a pun when you're going the right way. They also like a pun when things are slightly trickier. So you've got to take the rough with the smooth. But I think overall we've had a pretty good run with it. So, don't underestimate the power of media. Even when you're going through funding rounds, some of that early stuff was from when they raised £1 million or when they did small things. Journalists like a good story. They like a good brand. They like something that can tap into what consumers are thinking, consuming, doing, as you were saying about experiential experiences. What are consumers doing? Are consumers drinking at home more through lockdown? Tell us what you see. You're the pulse of how consumers are doing. Even a tonic maker can kind of say, especially when we're linked to spirits. So it's been a good journey. There's still much more to come. I'm, very proud and delighted to be part of a little bit to it. But, I hope that gives you an idea of the funding journey for a brand.
We'll have 15 minutes of questions. I'll ask one, and then I'll open it up to the floor for you guys to ask questions. I'm going to ask a general question because we hear a lot about problems with investors in the UK generally, which you reflected in your presentation. If you think of the 3 broad parties involved in this whole investment situation, one is the investees themselves. We heard 3 fantastic presentations. Do you think generally investees are bad at expressing and articulating what they've got for the investors to understand and want to invest in? Or are they overvaluing what they've got? Or is there something wrong with the average investee in the UK? Is it to do with the investors that you mentioned, that they're all too darn conservative? I mean, London clearly is awash with money of all kinds. So there's plenty around there. So maybe there's something going wrong that it's not finding its way to all these opportunities. So is it the investors? Or is it something to do with institutions and government? Tax breaks, incentives. You hear about government incentives for research and development, There were very strong tax advantages for being an entrepreneur, which are no longer there, really. They're being atrophied. So which of those three parties is really to blame? And if you could pick one thing, what would it be? So shall we start with... You've already nailed your colours to the mast, so you can start.
Remember, you have a British passport.
Yeah, how do you consolidate down? The one thing I'd say about investees, and I'm coming from the kind of venture capital private equity world, right, is they're probably coming through for the first time. And so they haven't been through the journey, and they haven't, thought about selling shares as a product. I mean, ultimately, you are selling a product that has the promise of future returns, right? And so how do you sell that? They haven't been through that. Usually they might be artistic in some way or creatives and things like that, but they haven't necessarily figured out how to put together a fantastic presentation for that. So that, to me, I think it holds up stuff. But the fact is that private equity can be pretty nasty. Loan notes are an evil structure. And I can say that pretty reliably because my lawyer friends at CMS and other places agree. That said, Trispan, where I'm a part-time operating partner, we don't do nasty stuff. And actually, that private equity firm, the management team behind it was the management team behind the fund that invested in me originally when it was a family office. So we have obviously a great relationship because they've asked me to be an operating partner as a result of that. But I do think the government could be doing a lot more. That said, I look at the U.S., and they don't do a lot to incentivize. In fact, they've got blue sky laws across all these different states that make it incredibly difficult to raise money. And over here, we have EIS and SEIS, which are fantastic. But something needs to, I haven't figured it out. I don't know. But we need more investment, and we need to be less conservative. The French and the Germans are less conservative than us. That's ridiculous.
Damon, what do you think?
So I suppose talking about maybe more on the kind of government side then, so where British Design Fund operates, we do see the UK, I think the UK has got good incentivization. So we mentioned SEIS, so all of our seed funds are SEIS, that's great. So you de-risk it for your investors. They typically apply then to innovation-rich businesses, so that tax break de-risks it, and that definitely is part of our messaging with our investors. But also there's other breaks. It's a shame on the side of the founders. Let's see what happens kind of next year. But it does feel like the direction of travel is you're an entrepreneur. That's just like having a normal corporate 9-to-5 job, and it's not the risks. But it's it's the way it's going with some of the kind of entrepreneur relief being taken away. But I kind of think entrepreneurs are so dysfunctional and go against the grain. They'll probably do it anyway, But it's a shame that that's the direction it is taken in the UK. But there's lots of stuff I think the government is getting right, and the tax breaks for investors is great, but also just the non-dilutive stuff. The stuff from Innovate UK. The R&D tax credits. There's a lot, and when you look at the US, it doesn't really have stuff like that. The US, so we're really good at that very, very sharp early stage. We get them started, but I think then you start to see the kind of the lack of punch that the private equity VC space has. We just can't write the tickets, and lots of our companies, they get to the Series A and Series B, and they're crossing the pond, and that's where the kind of bigger checks are. But I think we're getting something right at the start, but we're getting quite a lot wrong later on.
Ollie, what do you reckon?
Yeah, I think from sitting in numerous meetings with Tim and Giles, and Natalie, Tim with investors, there's no doubt that entrepreneur with their own business, the sort of passion that you have for it can sometimes slightly cloud the relationship with the investor, who potentially, cares obviously about the brand to some extent, but really wants to know about their return and their return horizons, rather than potentially the opportunity for the brand and, that long-term vision that potentially the founder sees. So there's no doubt that can sometimes cause heads to butt. But at the same time, I think, like I said, they've had some fantastic long-term shareholders who are willing to, take the rough with the smooth. I think there is a short-termism in London and on the stock market, especially with the analyst community and everything else. You're being judged on a 3 or 6 month reporting cycle. You're being judged on short-term trends, and that longer-term picture sometimes gets gets forgotten. I think the media play into that as well. So I think that definitely frustrates. But once you find those investors who are willing to ignore that noise and say, look, I believe in this for 3 to 5 years. I believe, the Warren Buffett as well. It's not easy. There aren't many around, but once you get those on board, then I think you're in a much better place.
Can I add one quick thing? So I'll put my British passport back on in my pocket. We are great at investing in technology in this country. We do have a lot of infrastructure, a lot of incentives. There's all kinds of plans. It's great. British culture is legendary around the world for decades and decades and decades. And we have things that are being created. And if you're not familiar with swingers, it's a golf game, so just in case clear that up. and Flight Club, which hopefully you guys have all played, it's just incredible. Those are being exported along with Bounce and some of these other competitive socializing businesses, which are unbelievable with their returns on capital, twice the return on capital of restaurants around the world. But we don't have enough, and those are they've broken through, but there isn't enough of the stuff that's outside of tech that's getting that attention to be able to push, the creativity that's very unique in Britain in terms of, how far it reaches historically.
Okay, I'm going to give my hobby horse view, just for the sake of it, and then I'll ask a couple of questions. It always strikes me as ironic that Entrepreneurs Relief was thought up by Labour and introduced by Tony Blair, and I thought was a very generous, strong incentive, and there was no limit to the amount that you could get. And gradually, over the last 13 years, they've wound it back from limitless amounts of capital gains to £1 million now, and they're even talking about abolishing that. And somebody that we know from Twickenham, actually, who ended up as head of the HMRC, but was actually a tax lawyer, and I don't think he'd ever worked for an entrepreneurial company ever, he said to my face, I really don't think Entrepreneurs Relief there's any evidence that it creates an incentive for people to become entrepreneurs, which is so completely ridiculous in my opinion. And it would be very ironic if Labour get back in next year and the first thing they do is reintroduce Entrepreneurs Relief, which if they do get elected, I hope they do. But going with that, the other side of it is that the reason it's so scary setting up businesses, generally you've got to, at the early stage, you've got to give personal guarantees, either to the bank or someone. I'm not quite sure what the horror story is with loan notes, but I can imagine. But, having to give guarantees to bankers who are highly conservative probably kills more business than anything else. People just won't go to be entrepreneurs. So that's my hobby horse. Now, 2 questions and then we'll have coffee.
My speciality is crypto, blockchain, Web3. I've changed from a traditional real estate property investments into that area. A question to the panel is in relation to cryptocurrency and accepting cryptocurrency for your investments. What is the panel's views on cryptocurrency being accepted as a form of investment in your portfolios?
I'll take it. So, can I wrap that all into blockchain? Crypto is one particular thing, but with blockchain. So imagine that we want to raise out £1 million, right, for a restaurant. We could go out and raise £1 million where we're going to give everybody, they all take £1,000 or something like that. So you have 1,000 investors. We're going to give you £1,000, each of those 1,000 investors, worth of free food. So essentially, you're giving us the money and we're giving it back to you. After VAT, our gross margin is 75%. So that means, 85%. So gross margin 75, take away VAT, 80%. That means it's only going to cost us £200,000, which we could finance over time as we're getting through revenue from various folks. So blockchain has unlocked this ability to raise funds where it's not just about the equity, it's about these other intangibles and memberships and part of the crowd and everything like that that enhances it, which is just incredible. But nobody's really gone down the path on that. I think it's going to happen. Cedars has just got bought by Republic in the States, and they're kind of introducing some of that stuff. But I think that's going to change things.
Yeah, I mean, from our point of view, we operate in a regulated space. So looking at it from a sort of institutional investor is tricky because there's just, and the direction of travel, certainly for when we're dealing with retail investors' money is. It's all KYC and AML, and it's tough enough. It's tough enough getting money from outside the UK. I can't even imagine how difficult it would be if we tried to raise in that. But it's not something we're experienced in.
Until the LSE allows that to happen on buying and selling shares, I don't think it's something that we consider. But I think that early stage investment back in the day, I think Tim and Charles would explore all things. So the more opportunities for retail investors, as long as they go in with their eyes wide open, and to your point, the regulation is there that they don't get burnt. Then I think everything should be considered.
I'm going to take one more quick question, then we're going to break for coffee.
Thank you. I just wanted to follow up on this point about the conservatism point about among investors in the UK and Europe. I'm really disappointed that nothing seems to have changed much over the last few years. About 10 years ago, I conducted some extensive studies interviewing venture capitalists in Silicon Valley, UK, Europe, and so on, part of a big research study. And it was definitely the point that in the US, it's all about, they ask the question, how do I win if I invest in this particular company? Here in the UK, it's how do I not lose? And we want all the downside protection in place to try and get our money back if we lose. Whereas in the US and Silicon Valley, they don't really think about that. It's all about the upside. And 10 years ago, venture capital in the UK and Europe was abysmal. It was negatively performing. If you took all VC funds together, the British Venture Capital Association, the figure was like minus 0.5% per annum return. It was terrible. No pension fund would invest in VC. And yet now the returns are 17% per annum, the same as private equity. And so something's changed in the last few years to improve venture capital performance. So any ideas on what they're doing better these days?
When you look at the US and the size of it, there's this kind of notion of we're going to invest and then this thing is going to explode across 50 states and 300 and whatever million people and everything like that. When you look at when I look at venture capital investing over here, where consumer investment, I started a business that was a competitor to Fever as an example, and it was like, we need recurring revenue streams, and it needs to be B2B, and it needs to tick the box on all these different things, and it needs to be incredibly safe. There's no big box thinking or big blue sky thinking, right? Part of that's also limited to this opportunity is a UK opportunity, and there's all of Europe, and we just kind of always are thinking about the UK, and this happens in the restaurant industry as well. I asked the village elders when I was younger, guys, why not go into France? Why shouldn't we go in Germany? Oh, we just don't do it. And you love that answer, right? Because there's no meritocratic reason why we don't do it. It's just, we just don't do it. So I think maybe my hypothesis would be that we're thinking a bit broader. We're looking at going into the States. We're looking at going across Europe. We're taking a bit of a more global view on these things. That is a larger opportunity. Therefore, we get better returns and things like that, and more things can be financed. But it still feels fairly...
Yeah, another observation might be, I suppose, maybe the operators are changing slowly, but they are changing. If you think, and I can't think what the statistic was. We were reading something last month about the number of VC operators, the guys setting up the funds that have never run a startup in their life. It's quite shocking. But the numbers are slowly changing. So I think if you look at the last sort of 10, 15 years, a lot of it fueled by tech, but there's a lot of those guys that took risks, understood risk, set their companies up, exited, and then have gone on to set up funds specialised in the areas that they now know. And that then brings with it a very different risk appetite to, say, a stereotypical, say, VC or private equity fund set up by Goldman Sachs guys, right? It's a real different appetite for risk and understanding of it.
Okay. I hope you enjoyed that session. I thought it was very interesting. Thank you very much. The next presentation is Brigitte Trafford from the London Stock Exchange Group. She has very kindly allowed us to hold the event here. Even my little challenge about the London stock market having to fight for its market share, though I think actually it's in a very good position to do that. And part of that is the amazing new strategy that has been developed under Brigitte, launching it, and you can't miss the advertising if you go up the drain every day. And here to talk about how it was developed and what it's going to mean is Brigitte. Thank you.
Thank you very much, David, and delighted to be here with all of you today. So I joined LSEG in the autumn of 2020 in anticipation of LSEG acquiring Refinitiv. So our number one priority at that time was brand, to make sure that we were ready for day one. It was the very first issue that we tackled. The company had been growing very fast. Actually, I think I've got, let's see if I can do that. We're just on that side at the moment. The company had been growing very fast, both through acquisition and organically, and it become difficult for customers to actually navigate us, certainly salespeople to sell, or even employees to fully understand what we do, and hard also for the investment community to actually value the company properly. So we thought there was a really exciting opportunity with day one to correct this by simplifying our brand structure, help build awareness and understanding of the full capability of LSEG, and unlock future revenue potential. And for those marketeers in the room, it was also a once-in-a-lifetime opportunity, I thought, to turn a 300-year-old company into one of the most iconic brands in the world. So to address this, we did two things. First, we set up a program to deliver the new visual identities and the complex change that sits behind a dramatic simplification like this. And we also developed our first ever global brand campaign. So this is where we started. So as you can see, more than 25 brands without any connection, either visually or by words. And as you'll all know, it's very expensive and time-consuming to build equity in that many brands. And that was creating a barrier to growth. All our stakeholders found it hard to understand who we are and what we do. And our customers found it very hard to navigate. And our sales force found it very hard to cross-sell. So, for example, only 44% of FTSE Russell customers knew that we were part of LSEG. So that was a challenge that we had to get over. But the biggest issue of all, and one that won't surprise you, I guess, given our name, is that there was a dominant, lingering perception that we only operated in London and that we were just a stock exchange. So we've taken a very thoughtful and methodical approach to creating a much simpler, clearer and connected portfolio and brands. Sorry, that was from the last slide. I thought that had gone. So you can see the new brand structure here, the LSEG parent brand at the top and 6 sub-brands underneath. And this new look and structure helps build equity in LSEG and simplifies our go-to-market structure. And as you can see, all the sub-brands are now much more visually connected to each other and all sharing the very distinctive LSEG blue. Now, we're on track to launch all of the sub-brands by the end of 2023, and that means we've had to refresh literally thousands of marketing materials and touch points and consolidated all of our web properties. But having brought this simplification to our brand structure, we then needed to build strength in the LSEG brand. Now, London Stock Exchange Group, you could argue, is a powerful brand, but names don't always do the best job at explaining what something is or does. And as I said earlier, most people thought we were just in London, just an exchange. So we needed to make it easier to understand the full global capability of LSEG. And our brand campaign seeks to change that perception and build awareness of LSEG globally, and to make people rethink what they thought they knew about us. So to do this, we used our name to emphasize everything that LSEG does. The campaign has an ownable design that acts as the visual thread across every communication touchpoint. And the design literally opens up in a way that helps with pronunciation, as people didn't even know how to pronounce our name. It was LSE Group, LSEG. So actually we wanted to teach people through the campaign. Oh, sorry, I've gone too early. Can I go back one? Sorry, that was me over. You can go back to where it's opening. If I no, that's not what I want. Okay. So somehow we've lost the visual. No. You see, this is live, kids. Anyway, you'll see it opens up. It starts to illustrate what we do. Wonderful. So you've probably seen it on the drain and in various places. But the hero asset of the whole campaign was the film, which you are about to see. From the very outset, I wanted to apply a B2C approach to the LSEG campaign, breaking the conventions of financial services marketing, which frankly, as we know, B2B financial services can be a bit stale and a bit safe and frankly, totally immemorable. So I challenged the agency to make it like a consumer campaign that would make sense to anyone who saw it, regardless of whether they're in the financial services sector or not. And actually, I wanted to put humour. I wanted to put the funny in financial services, which again, I guess, was all about getting the tone right. So anyway, our film brings humour and a warm approach with a bit of intelligent wit, I hope. Anyway, here it is. It's only 60 seconds, so bear with me.
In the world of finance, names can be a bit misleading. Take ours, for instance, pronounced LSEG, aka London Stock Exchange Group. Sure, we're in London, but we're also here, and here. In fact, we do business in 190 countries. We're practically everywhere, except here. Well, not yet anyway. We're proud to be one of the world's biggest, most international stock exchanges, connecting capital with ideas for centuries. But that's just part of what we do. Today, we connect the news, information, insights, and systems to create possibility across the markets, partnering with almost every major financial firm in the world. You see, others do some of what we do, but not everything we do. Instead of LSEG, we could have called ourselves the London and practically every other place in the world stocks, bonds, currency, data, analytics, indices, risk management, clearing, exchange, multi-asset class group. But that's a little wordy. LSEG.
Thank you. But to take a step back, having persuaded my CEO and the rest of the ExCo that we needed to build our brand, that it was a good thing for business, our intangible asset, as David would say, the next thing we had to do was to make the case for funding. Now, as this was the first time that we'd ever done a brand campaign, we didn't have any of the historical data that we actually needed. And so that, with a shameless thanks to Brand Finance, is where we reached out to Brand Finance. And they helped create a model to identify the ROI at 3 different levels, because one thing I've learned in my executive career is you have to give the boss choices. And the transition impact model demonstrated the impact that the brand change would have on revenues, depending on the level of spend in the marketing. And it helped us really, I think, win the argument. Well, it must have done, because I gave them 3 options, and they signed off the maximum or the optimum level. So we're delivering the campaign in 2 phases. So this year, phase 1, we're just asking our audience to look again at LSEG and help them understand that there's more to LSEG than what they thought. And next year, we're going to do the sub-brands and how they ladder up. We work with our sales team to identify our most strategically important markets, because although I'd got funding, I obviously didn't get limitless funding. So I had to make sure that the money I had worked. So we obviously wanted to reach customers, decision makers, investors, regulators, governments, policymakers. And we targeted through 15 key markets in North America, EMEA, and APAC, but with 5 cities, New York, London, Paris, Hong Kong, and Tokyo, having a significant outdoor element too. So if you were in Hong Kong, you'd have seen the iconic trams covered in LSEG blue. We had taxis in the City of London. In Charles de Gaulle Airport in Paris, we had branding there. So I think we were quite clever in that it looked like we were everywhere, but we were just very clever with where we tactically placed it. And we generated over 250 million targeted we aimed to have 250 million digital impressions over the 3 months. Now the campaign, sorry, you can tell I haven't mastered the clicking. There we are, the 5 cities. The campaign was fully integrated with adverts on billboards, taxis, trams. We were on CNBC and regional media partnerships, online, programmatic, and social podcasts and more. And David, I'm glad you saw us on the Dream and actually at Waterloo too. But a really important element of the campaign for us was employee engagement. And so to do that, even before the campaign went live, we had like a film premiere for our employees the day before. The whole organisation stopped for an hour. I'm not saying I really felt the pressure, but I did, to actually launch the new campaign and our values. And we encouraged employees to take selfies of themselves with the campaign as they saw it. And I'm delighted to say we got hundreds of photos in from employees around the world when they saw the campaign. But what really surprised me, especially as we didn't ask for this, was we started getting photos in from government officials, from customers, and investors, saying, because funnily enough, to your point, the investors were thrilled that actually LSEG were investing in the brand. So, which again was very welcome ears to top management. Now, part of securing the funding, as you know, there's always a price. I did commit to saying that some of our key metrics in our annual brand and reputation monitor would increase. Now, that survey went out in market in September. I haven't got the results yet, but I am hopeful, and we'll see. But I do have some stats to share with you. So this is as at 25th of October. So we've had like 184 million impressions. So that's 73% already of the target that we set. We've had 102,000 searches through on our website with a click-through rate of 32%. We've had 539,000 unique visitors to lseg.com, including our local language sites. But I guess one figure which I really particularly love, because it's my lovely brand film again, it's been watched more than 48 million times. But of this, 66%, so that's more than 32 million people, not counting you kind folks, which we'll add into the data. No, we won't actually, because it's not how it works. But anyway, have watched at least 75% of the video. And you know, as marketeers, you know, even you get people to click on it, it's keeping them engaged and through. So look, in short, we're very pleased with how the campaign has landed, and we're pretty sure our investment in brand will benefit us all commercially long term. And I look forward to having the numbers to prove that at a future stage. But that's it.
Do you want to take any questions?
Yeah, very happy to take questions.
Anyone want to ask a question? Lady over there.
I thought your film was great, but why did you choose an American voice for it?
Oh, that was very deliberate. It was very deliberate. I didn't want British, and I didn't want male, because again, it was about changing perceptions. And actually, the US is our second biggest market, but that's not why we went for a US voice. I think research will say that actually, if you're a natural English speaker, the American accent is the easiest to understand. So that was why. But actually, it was a very deliberate choice, and thank you for asking that question. I couldn't have planted it better myself.
So, what was your main challenge in trying to convince your, the other part of the company that branding was important?
We'd never done it before. So, look, it was very easy in the end. I had a CEO who believed in it and wanted to give it a try. So when you've got the CEO behind you, everyone else has to fall into line. But he did want a bit more fact than it's great, which is why we reached out to Brand Finance, because I thought I need a reputable third party to help me assess how much we need to spend. Because, of course, if you've never spent money on brand advertising before, you know, did I need 5 million, 10 million, 25 million? I mean, when do you begin to get the maximum ROI? And so that helped, I think, because it looked like we had gone to experts who did this for a living, who could really help equate it, rather than me just saying, well, I don't know, what do you want to give me? I'll spend whatever you give me. So I think that was it. And also the thing about ExCo is we were all having the same lived experience every day, right? Every meeting we had with anyone, from friends, family, regulators, journalists, it would always begin the same way. London Stock Exchange Group. You're the stock exchange. No, very important, iconic part of our business, but 3% of revenues. Really? What's the rest of it? Well, we've got data analytics, we've got the indices, we've got post-trade business. Right, didn't know that. That gets, and look, it's completely understandable that people didn't know that, because 10 years ago, that's exactly what we were. We have grown very quickly through acquisition and organically. And the name is the name, right? So as they were having that daily experience, I guess David has more meetings than anybody else, he desperately wanted a way to cut through that and actually educate people, which is why our first part of our brand campaign is actually more educational than anything else. It's not actually talking about that much about products. It's a nod to the products and what we do, but it's actually just we're not just in London, and we do lots of things across the trade life cycle. But that's why I think he just got, I came, he'd been in place 2 years. I think by year 4, it's exhausting. It was kind of like, help me, do something. Now, I had to compete with other people for money, and so I did have to sign my name in blood, to these KPIs. But I'm fairly optimistic, not least because we really did our homework on investment, but we're really thoughtful about how we placed our media, but also just the response from people. People have seen it and have thought about us again. So I'm just hoping that the monitor shows
Just one
that.
very quick one. You say the name is the name.
Yeah.
How much value was ascribed to the name rather than, put it another way, was there a consideration around the renaming or rebranding up to the name? Admittedly, the market is awash with terrible renamings of brands, fairly innocuous. But was there so much value ascribed to the name of the London Stock Exchange that couldn't be changed at all?
So I don't think it was the value. I think the view was, well, when I arrived, I very much got the distinct impression that was not up for debate. And actually, to an extent, as a marketeer, it doesn't really matter what you call it. It's the meaning you put behind it. So, I always use WPP as the example. Everyone knows it as a famous advertising agency, but that's not what those initials stand for. And I guess what we're trying to do with LSEG is very deliberately doing what American Express, I guess, did with Amex. So yes, they've got a credit card, which is one of their products, probably more famous than the parent company, but they're trying to build the Amex brand. And same with LSEG. I'm hoping that in 10 or so years, a bit like HSBC, people may not even know what the letters stand for. It doesn't matter anymore. So I think, it wasn't, I got the clear sense it wasn't up for debate, but I didn't think that was the problem, because actually, as you say, you changed the name, you've still got the same issue. And I'd much rather take the 300 years heritage that is with the stock exchange and expand it and show people there's so much more to it than try and come up with a random other name.
Is anyone desperate for one last question?
Have you secured funding for next year?
Yes. Yes, no, it was a 2-year programme. We were very clear on that too. It's kind of like, it's not a one and done, it's 2 years. And how we were going to spend the money and everything else. But what surprised me was we had a very detailed media plan, which we really tested internally. And I was expecting to have to present that and almost get that approved. But I never did. It was kind of like, oh, where are we going? All right, okay, cool. Which again is as it should be, right? They trust you because, as we know, advertising and media buying is a subject to which everyone approaches with an open mouth, right? So it was good. But no, they understood that it's not a one-hit wonder. I guess the trick will be, will we get funding for year 3? Oh, the other thing I should say is the funding for brand was carved out. It was specialist money, so it's not a part of my BAU money, which continues to get challenged. No, the idea was this is a group strategic project, a GSP. We all love 3-letter acronyms. And as such, ring-fence funding. But it means that I could only spend that money on this, not on other things that I wanted to do, like hosting this wonderful event. It had to be on the campaign, and it's for 2 years, and then it'll be. Hopefully, they'll have seen the benefit of it, and will continue, because everyone understands the theory, but it's really hard, especially when some of the day-to-day product marketing. You can see the direct line between paid search and sales. So it's quite an addictive drug to break people off, to do this as additive as well as instead of. But anyway, I hope you found that useful and interesting.
Thank you very much, David, and thank you, Brigitte. I think that's a really good illustration of why it's important to think about activities, both in terms of branding and innovation in terms of the value that you're creating. Today we've launched the 2023 report of our Global Intangible Finance Tracker study, which is a study that we've been doing since 1996 to monitor how much intangible assets are worth worldwide. When we think about businesses and how they create value, it's because they control specific resources. And we can think about these in two different classes. Tangible assets, so for example, the plant and buildings that you have, any equipment that you might have. But then, more interestingly, there's the class of intangible assets. So that includes things that you can't really touch and don't necessarily have a physical substance, but they have physical evidence. So, for example, your brand, any technology that you have, and then also, for example, artistic value. So if you're thinking about Universal as a company, they have significant value in the movies and music that they create. The way that companies share information about this to investors is really important because it tells investors how much value companies are creating. And that's traditionally done through something called a balance sheet. And I'm going to be talking today about the balance sheet, what it means, and how I think it needs to evolve. So first of all, I think it's important to think, what is the objective of a balance sheet? I think many people might ignore balance sheets today, or think that they're an antiquated document that's just required by different regulators. But really what the balance sheet is trying to do is demonstrate to investors and owners of the company how much resources that company controls and how it's funded. So on one side of the balance sheet, you have the assets that are created and owned and controlled by that organisation. And on the other side, you have how it's funded, so either through bank loans or through equity. Now, the reason that's useful for investors is because it gives a snapshot view of the value of a company, ideally, but also helps investors to understand, well, how easily can they get their money back from the company, how much money is tied up in loans, and how much money could they potentially retrieve. But the balance sheet has evolved over time, and we're going to go back in time to the 15th century. For a few hundred years before the 15th century, Italian merchants had been starting to use something called double-entry bookkeeping. And this was a way of managing their businesses and accounting for the different transactions that they were seeing through two entries. So essentially, double-entry bookkeeping, for anyone who's not an accountant, is when you have one transaction, but you record it in two places. And those two things have to balance. So, for example, if you sell a cup of tea, you recognise both the fact that you've got some income from that and also that you've received some cash. Very basic fundamental theory, which most accountants today just take for granted, but it was popularised because of this man, Luca Pacioli, who was a Franciscan monk based in Venice. He was a mathematician, and he wrote a seminal piece called The Summa, where he talked about lots of different mathematical theories, and there was a small chapter at the end which talked about this concept of double-entry bookkeeping. And really that's why he's credited as being the father of modern accounting and creating this concept of the balance sheet. And he didn't just do this for the sake of academia and thinking it was mathematically interesting. He did this to help companies understand how to control their costs and manage their business effectively. And his work has been credited with many different companies over the years, their survival. Wedgwood, for example, the famous China company from the UK, said that if it wasn't for the balance sheet and double-entry bookkeeping, they wouldn't have survived as a business. And that's been going since the 18th century. The next significant shift that happened in financial reporting was in the 17th century when the East India Trading Company became the first joint stock company. So this is the first time that people could invest in a company and have ownership of that company. Before that, it was sole proprietors primarily who both owned and operated their businesses. And the East India Trading Company evolved from allowing people to invest in individual voyages, which were quite risky, and sometimes the ships sunk, they didn't provide a return on that investment, to allowing individuals to invest in the company as a whole. And that's where we got this concept of the owner-manager divide. And with those investors, they then wanted to know, well, how is the company performing? Am I going to get a return on my investment? And so this is where the pressure started to mount on companies to disclose more about their financial performance. And also the complexity of these different voyages, multiple voyages going at once, and also the longer term that it requires to get a payback. This is where we started to get some of these concepts in accounting of continuity, periodicity, and accruals, which I can see a few eyes starting to shut at that, so I won't go into too much more detail. But essentially, the balance sheet started to evolve. Because of changing the way that businesses operated, the way that we account for assets and their value had to change as well. Then comes the early 19th century, the Industrial Revolution. Organisations, particularly here in the UK, invested heavily in fixed assets, in machinery, looms, what was needed to drive that innovation forwards. And so again, we saw a change in the way that balance sheets looked because they had significant fixed assets. And companies then started to have to think about, well, how do I demonstrate that this is something I'm investing in today for future gain and longer term return to the business? And being able to articulate that to their investors was very important. At the end of the 19th century, we saw a boom in corporations in North America and the introduction of the North American railways, which fundamentally changed the way that businesses operate and financial reporting, the role of financial reporting. Because of the railways, it was possible to get a return much faster on your investment. And therefore the appetite for investors was much higher. A couple of things happened as a result of that. Companies, particularly the North Central Railway, started to report on more things. So they realised that balance sheets, yeah, interesting, but actually there's more information that we can share with investors to show how appealing it is to invest in our company. So they started providing these things that they called working capital funds reports, which is essentially the origin of the modern day cash flow statement. We also saw stock market advice become more popular. So the modern day Standards & Poor's has its roots in Poor's Directory of Railways, which is, that's a snippet of that. And we also saw the birth of the accounting profession because there was a need for independent advice on financial performance. What all this goes to show is that the balance sheet has evolved and the way that we report on financial performance has evolved over time, driven by the need to attract investors. Also at the end of the 19th century, we have what I like to call the intangible asset problem coming to the fore. Because we had a swelling in profitable companies, there was a higher volume and value of transactions for those companies, so people selling them either after the owner passed away or during their lifetime because they wanted to receive profit for what they'd created. But something odd was happening where the transaction price for these businesses was in excess of the assets that they had on their balance sheets. And people didn't really know what to do with this at the time or how to interpret it. And so they started calling it goodwill. And they said that this was the additional value afforded because of the owner and their reputation. So often it was just treated as a payoff to that owner and like a pat on the back of, well done, thanks for what you've done. And it wasn't seen as something that was retained by the company that had been bought. Fast forward 1.5 centuries. And today what we see is that the most successful businesses now, Apple, Amazon, Microsoft, are vastly driven by intangible assets. We have data on that from our GIFT report that we released today on how much of their business and their assets are represented by intangibles. We also have the luxury of 1.5 centuries of academic research and evidence on what exactly these intangible assets are that prove that companies can actually retain and control intangible assets, which was not something that people understood as well at the end of the 19th century. So we now know that it's software, it's brands, it's specific things that companies create that drives this intangible value. But the challenge for balance sheets is that they have not evolved to allow us to account for these intangible assets. And when we look at the 5 biggest companies, publicly traded companies today, we see that the vast majority of their value, for Apple, for example, 96% of their value, according to their enterprise value, is not on their balance sheet. So investors just can't see this information about the value of the intangibles that that the companies are creating. And this problem becomes more acute each year. As I mentioned, we've been tracking global intangible asset value since 1996, and on average it grows by about 10% per year. In the study we've released today, we are sharing that global intangible asset value amongst publicly listed companies stands at about $60 trillion. And if you want to try and make sense of that number, think about the fact that US GDP is just over $23 trillion. But it's not all dark and gloomy. What we've seen since we've been tracking intangible asset value for the last 25 years is significant developments in the focus being placed on intangible assets. Various different international organizations and accounting standards boards recognize that intangible assets are driving business today. And so there's been momentum, which, as you can see, has been accelerating in the last 5 years towards how do we actually go about accounting for intangible assets. And I think it's key to remember here that the goal of a balance sheet and the goal of what we present to the external world in terms of financial reporting is to raise finance and share information with investors. There's quite a few different developments on that page. I won't talk through all of them, but one of the most exciting ones for me is that the International Accounting Standard Board has added to their official research agenda intangible assets as of last year. So we look forward to seeing what comes from that. Another interesting development was in September this year, the Intellectual Property Office for Singapore released an intangible disclosure framework, which is the first major framework of its kind, providing guidance to businesses on how they should think about disclosing this information to the external world. So the question is, how can the balance sheet evolve to account for intangible assets? It could adapt, like we saw in the 17th century, where the change in the way that the economy worked meant that the balance sheet just had to evolve, and the way that we record asset values had to evolve. And that could mean recognizing your intangible assets at their fair value, so how much an optimal investor would pay for them. Or it could be something more conservative in terms of capitalizing what's being invested in intellectual property development. Or maybe it can't. And maybe the balance sheet should be retired to history and instead be replaced or supplemented with new financial statements like we saw in the late 19th century with the introduction of cash flow statements. Now, something that's interesting about what the railroads did is that they started reporting on cash flow statements and those working capital fund reports 100 years before it was required. So it was only 100 years later that the US Accounting Standards Board said everybody has to disclose cash flow statements. And the reason they started doing it 100 years before was because they felt they had important information to share with investors to help them compete for scarce resources, for scarce funds. And essentially we see the same thing today. Companies have an opportunity to share more information than they're required, to share information on the value of their intangible assets to attract funding. And at this point, I'm going to go back to the wisdom of Luca Pacioli. I like this photo because I think of the painting, because I think he looks like he sort of belongs at an East London rave warehouse.
It's the glitter ball.
He said there were 3 things fundamental to businesses being successful. First was securing funding, getting capital. Second was having good bookkeepers, so having a good accountant, having somebody who understands what's going on in terms of money moving throughout the business, where costs are being incurred, and how to control them, and having a good system of measurement and control. And this needs to be applied not just to traditional tangible assets, but obviously to the assets that are driving businesses today. So we would strongly recommend businesses to have a system of measurement and control for all of their assets, so intangible assets too, monitoring how much is being invested in those assets and what return that is generating, and having good bookkeepers to do it for you, which is why we do what we do. But I'm excited to hear from the next couple of sessions on this concept of capital and how we can reverse this concept on its head a bit and think about how intangible assets can be leveraged to secure funding and financing. And this is, I didn't touch on it, but on the timeline of developments, one of the other exciting things that's happening is a focus from intellectual property offices around the world on how to commercialise intellectual property. Thank you very much.
Hi, good morning to everyone. My name is Lorena Rivera. I work as an economist in the World Intellectual Property Organization, which is a special agency of the United Nations. So I think I will bring today the global perspective to what we have been discussing in the morning. And first of all, I want to thank Brand Finance, because we have been having this collaboration for a few years. So we use their data in our reports in the UN to try to help countries actually understand their innovation performance. And as Annie said, we have moved away from this traditional measurement of innovation to try to include some new metrics, and among them, intangible assets. So, is the other one? Okay. So most of what I will talk about today is based on our latest report, which is the Global Innovation Index 2023. And in particular, we have this new part of the report that we call the Global Innovation Tracker, which is basically showing the global landscape of innovation. So really from a very high level point of view, what is happening around the world. But I will start with taking one step back and try to explain why we focus on innovation, because we work with governments in trying to help them use innovation as a tool for development. And what I'm showing here is really a graph showing productivity growth from, historically. And I think what I'm trying to tell with this graph is that productivity is actually a major contributor to increasing living standards. So what you can see here is that there is a very flat period that went up until basically the Industrial Revolution, where there was no much changes to productivity growth or living standards. But since then, technological innovation has helped boosting the living standards around the world. So if you look from the 1817 or 20 to 2021, this has increased by 24 times. So I think this is, from the United Nations point of view, this is our tool for saying investing in innovation, it makes sense because it will increase, or is a tool for economic growth and development. Now, what I mentioned before, we take the innovation phase or the innovation cycle to try and, through several metrics, try to understand what is the global state of innovation. We take it from the investment side, technological progress, technological adoption, and socioeconomic impact. I will mainly focus on the first part, investments. And as you can see, this is the picture of 2020 in the 2023 report, which mainly concerns data from 2022 and 2021. And basically shows that in the investment side, things are still looking good. So this is traffic light system. So, whatever is green is good, whenever is red is bad, with the exception of venture capital deals. And this is the value of the deals. I will go that in more detail. And, for the rest of the metrics, the picture is a little bit more nuanced. So we have some metrics that are improving, some that are not improving, and in particular, the socioeconomic impact. So, how innovation is actually helping people around the world. So let's start with investments. So I think what we're looking today is really this improvement in innovation investments around the world. Innovation has become actually a priority for countries, and it's not before. What you see on the left-hand side is, the picture before. Before it used to be just a matter of a few economies around the world, high-income economies mostly, that were focusing on innovation as a driving force for technological development. innovation systems were more ad hoc. They were, there was not a lot of competition, and there was not such good availability of innovation funds. The contrary is happening now. However, innovation ecosystems around the world now are highly organized. We see an increasing importance of emerging and developing countries in this setting. There's a fundamental role that is played by government in incentivizing these innovation ecosystems. And there's more integration between the science part and the innovation side. Now, we call here about an overabundance of funds or this era of cheap money. Now, what we're thinking about what will happen next, and this is based on what we're observing to some extent now, is this changing of trends. So we think commercialization will be harder and harder to happen. It will become harder and more expensive, actually, to innovate. Once again, soft intangibles and data will be a key drivers for innovation. It's already now, but also in the future. And for the bad, certainly, but now we're living in a world which is dealing with a lot of conflicts, trade disintegration, and so on. And this will most likely continue to happen also in the view of global crises, such as climate change. So there will have to be businesses will have to adapt to this new era of conflict. So this era of high interest rates, low venture capital that we are already observing, and what we call the funding winter. Now, once again, today we see that the world leaders in innovation are more or less stable. So what you see in the bottom is by country, the countries that are the most innovative in the world. So we know there is this high correlation between levels of income and innovation performance. So there's no surprise that European economies and the US are on top of the rankings. This is there's this high concentration in some innovation hotbeds, what we call, and also companies. And it is mainly still very localized in Western Europe and the US. But we see more and more catch-up, particularly in Southeast Asia. China, without a doubt, is becoming a huge major player. And together with other economies, emerging economies that are kicking really up, not only on IP activity, but also in many other metrics of innovation, such as Turkey, Vietnam, India, Iran, the Philippines. So this will be major economies driving the innovation landscape. So what you can see is that we're passing from these highly concentrated markets to move into a less concentrated global landscape of innovation. India is certainly, or will be, a key player, together possibly with Brazil. Northern Africa is also playing an important role. And hopefully this will spread to other countries. There is, and I will talk about Africa because this is one of the regions where venture capital has increased considerably in the last years. Now, when we talk about investments, and we heard a lot about the investment side in the first panel, what you see on the left-hand side is how global R&D has evolved in the last 20 years. So the green line is the global R&D investments. So as you can see, it has been increasing. Now, the blue line is the world without China. So a big part of this gap is financed by China. And the dark blue line is the world without China and the US. So you see it has been increasing, but if you look at the dark blue line, mainly the big drivers of R&D investments are the US and China. And this is what you can see in the bottom part. So it has been more than double in the last 20 years. But this is mainly that light blue bubble is mainly the Chinese investments in R&D. Now, that is public, or that is a total R&D. What you see on the private corporate global R&D is a similar story. So we see, for example, the US in 2020 having a huge boom on private R&D investments. Europe, more or less flat or flattish. China, incredible boost in 2020. And for the rest of the world, and even these are the major spenders that you see on the left-hand side, relatively flat as well. Now, when we look at sectors, specific sectors or where are these companies? Who are these companies? So most of these sectors are in the ICT and ICT services field. What you see there on the right-hand side, which is actually compatible with what Annie just showed on intangibles. Most of these companies investing the most in R&D are in this ICT services field. There's a lot also in the pharma and biotech industries. However, you have to bear in mind that this is 2021 data, so there is a big COVID-19 component in there. And automobiles, that is a bit more traditional, but a lot of investments happening also in relation to green technologies or climate change related technologies. Now, let's talk about venture capital. These are the number of venture capital deals around the world. So as you can see, 2021 was a boom in venture capital investments. The line is actually the growth rate. In 2022, the number of deals continued to increase, but there was a decrease in the growth rate. Most of this increase happened in Asia, but the second region of the world was Latin America. The third was Africa. So in WIPO, we like to call it the democratization of venture capital, because venture capital is now spreading around the world. It's not only focalized on developed countries. Now, the bad news are the deal values, what I mentioned before. So in terms of deal values, the value of the deals decreased considerably. This is almost by 40% in 2022. Now, if you take this amount of number of deals increasing and value of deals decreasing, basically the average value of each deal halved between 2021 and 2022. Now, what does this mean? Again, most of the markets that continue increasing again were in Latin America and Africa. In Europe, it's more or less flat. Now let's talk about IP and IP filing trends. I will show you with data in the next slides, but IP filings and IP bundles have been increasing in the last years. There's a lot of recognition around the world of the importance of IP and also non-patent IP. There's an emergence of new actors filing, particularly the Republic of Korea and China. And IP systems now are much more organized. There's more international protection. And this really is a change for what happened before, which is very few IP filings, a highly concentrated IP filing market, basically in Europe, the US, and later in Japan. But what we see for what might happen in the future is really this less exuberant and more calculated use of intellectual property. So I think companies are really using intellectual property when it makes sense, not just all the time. We believe it will be more critical to finance, and this is why we're focusing more on the using IP as a backup for financing models. And there will be more, further spreading to major actors. And you will see now in the next slides, most of the most growing markets for IP filings are not in Europe or the US. Once again, this is from a historical point of view. From the 80s to now, there has been a boom in IP filings, but that is close to 3 times from what was happening in the 80s. But once again, the green bubble now, most of these IP filings the increase is mainly driven by China. So it makes us wonder how are the markets emerging? And here I take a more historical perspective. We see in this phase 1, these again are the top patent applications for the top 5 offices between 1883 and 2021. There has been in the phase 1 is this very flat that you can see more or less until the 1980s or the late 70s. Then there is a boom in high-income countries. In 2000, you see this blue line, once again, China booming. And what we see more and more, you don't see India there, but most of in our latest IP statistics, most of the markets growing are China, Iran, Turkey. So this is one very compatible to these most innovating economies or these game changers that will, shape the new landscape of innovation. So that was for investments. Now we'll just talk very quickly about the other two parts: progress, technological progress, and impact. So technological progress, we have a few measures, but I will just focus on this one, which is basically the cost of sequencing the DNA of one human genome. And this is important because this helps in understanding, this is really important for example, innovation in the health sector, and also for, understanding new viruses and more kind of the deep science part of innovation. So what you can see, this is only basically in 20 years. The cost of sequencing DNA has passed from $100 million to $500. And this is really a breakthrough because this is much faster than this Moore's law that is often used for the semiconductors industry. So, this is basically to show that technological progress continues to deliver new breakthroughs. And there's a lot of potential, especially in this new deep science, what we call the new deep science innovation waves. However, I need to end on a kind of negative part. What I'm showing here is, again, we have a few metrics on the impact of innovation. Basically, we take life expectancy, carbon emissions, and a few other metrics to show how technological innovation is actually helping. And this is, of course, there's a lot of the COVID-19 components, but what you see here is, if I'm not mistaken, healthy lives basically end 9 years before death. So what we're seeing here is years of life beyond 60. And there's some that are healthy years and years that are beyond the healthy years. So I'm showing here the 30 countries. I think it's probably less in this graph, but there's about 30 countries in the world that still have a healthy life expectancy beyond 10 years. But the large majority of countries in the world don't. And they have, they even have a life expectancy that is below 60. So a lot of, from the trends we see when talking with policymakers, especially in the developing world, there's a lot of focus of using innovation for impact. And I think we're passing through the wave of just focusing on technology and manufacturing and so on. But a lot of economists now are concerned of creating innovation or excelling in metrics that can help to solve socioeconomic challenges, climate change, food security, and so on. And I think probably is this, in terms of investments, venture capital, intangibles, companies and countries that focus on these fields of trying to focus also on impact will be the ones that will be thriving most of the investments. And just to close, when we talk with countries, I think this is what governments, we try to put here, what are the top priorities for governments. Still funding levels, it has been, we've discussed this all morning. Funding is very important, especially as a percentage of GDP. There's this change in mindset. So there's a lot of the governments that have been successful don't talk about innovation in a silo. They really see this as a tool for development. Business R&D and innovation is key. So governments are the drivers, but they need to be working together with the business sector because this is the only way that real transformation happens on the ground. Data infrastructure, diversification, meaning there's a lot of countries still in the world that are focusing on natural resources or they're driving their economies through natural resources. We have a lot of research also in if the economy is more diversified, there will be more innovative and so on. These linkages, transferring, adoption of technology, and a lot of this cross-border knowledge flows. So you see the major force or the major driver that China is now. There's a lot of knowledge transfer in this story. And finally, brands, of course, and the social acceptance, and going back to the story of impact in this regard. So I'm just putting all of these things on the table, and we can follow up with the discussion. Thank you.
And thank you, Lorena, also for sharing perspectives on IP financing. We're going to do a very quick panel session with some questions from the audience. Aim to keep it to 10 minutes because we're going to try and make sure everybody has time for some snacks at the end, as David mentioned. David?
You heard my comment before the break about the role of tax breaks. You didn't mention that, no. Is that something that you've so far observed does work well elsewhere? And whether that person that I mentioned was right when he said that tax breaks make no difference to entrepreneurs thinking of developing this kind of IP, or not?
There are tax breaks for firms that commercialise their patents in the UK. That system is known as the patent box. It is a system that's found elsewhere. And there is at least some evidence that it does kind of help in that kind of commercialisation activity. So if you do, the patent box basically allows a lower rate of corporation tax from 20 to 10, I think. So there are tax incentives out there. But I mean, you know, if you guys have ideas on other tax incentives, it's not something that the IPO looks at. It's more kind of Treasury HMRC territory. If you do have any ideas on other tax, kind of incentives, happy to hear them.
On that, just a quick question from me. So, really interesting to hear about the venture capital value drop of 40%, quite harrowing. And we heard earlier about the conservatism of investors in the UK. Lorena, maybe a question to you. What can governments and businesses do to encourage funding of innovation and IP? What are the practical steps that they can take?
Yeah, it's a tricky question, actually, because I think when I was looking at the data, I realized that venture capital needs to be seen now from a really global perspective. So funds are drying up to some extent, and investors are looking at the world. So, you know, there's a lot of, the markets that are booming now are really outside Europe. And what these countries are doing are actually using innovation really as a tool for development. The government is pretty much the orchestrator. It works together with the private sector. And there's also key sectors. So in the Latin American market, for example, it's a lot on innovation finance, a lot in the financing industry, a lot in artificial intelligence, in the artificial intelligence field, a lot in the IT landscape. So is this use, for example, is looking into the future? I pretty much like the first section with the company examples, because it's really companies that are trying to disrupt the markets. And I think some of this, what we're seeing in these markets, are using artificial intelligence for very traditional sectors, for example, housing, or for delivery, food delivery, or it's really this combination of IT with a traditional market. So I think it's really these disruptive companies that are changing or are attracting investors, and also a lot of this is with the orchestration of government. Yeah.
Hamza, anything to add for what the UK Intellectual Property Office is doing to support businesses in managing their IP?
So I think it's worth beginning by saying different businesses have different needs, different understanding of the IP they hold. But for innovative SMEs in particular, the IPO does try to help them understand that managing their IP should be absolutely central part of their strategy. And in doing that, we adopt a digital-first, sector-agnostic approach that allows SMEs, in particular, to access the kind of education and tools they need at any point in time. But in particular, there are a number of kind of specific ways in which the IPO does this. It works with local authorities in order to introduce IP-backed or IP learning into kind of business training. It works with Innovate UK on what we call a IP audit and an IP access scheme that allows firms to identify the IP that they have and then to act on that knowledge. It kind of hosts webinars, training courses, and it also has a network of international attaches which help UK businesses abroad with their IP.
Great, thank you. I think we've got some questions from the floor. Ian?
Hi, sorry Lorena, you're up again. Fascinating and thought-provoking presentation, thank you. Are you measuring just innovation, or are you measuring invention, which is two totally different things and would give you different reports, and could actually indicate, if it's pure innovation, why China is so big on its growth?
Yeah, thanks for that question. I should have put a little bit in context how we measure innovation. We take a very holistic and broad approach. So I just presented there some metrics, but basically the index we use, it's based on 80 indicators. And these 80 indicators, it goes from very traditional measures, so R&D investments, venture capital, to more contextual metrics. So, in order for a country or for a company in a country to innovate, they have to have the framework conditions to be able to do that. So we also take into account, for example, the institutional part, the availability of human capital, the type of education side, but also we go to this very broad, so we measure inputs and we measure outputs of innovation, and in this output side is when we use data on intangible assets. So it's a very broad definition of innovation. Now, what I show here are more of the traditional measures. Now, if you look at other non-traditional ones, you will see other countries booming as well. And this is, for example, in the case of Africa and Latin America, they use other type of IP tools. It's interesting, for example, trademarks, industrial designs, those are booming more in the developing world. So it really, the picture is a bit more nuanced when you see this broader approach. Now, China, without doubt, when you look at the evolution over time, it's the only middle-income economy that ranks in the top 30 in the world. The next one is close to the top 50. So, there's something clearly happening there that is supported by the IP data and the R&D and the business R&D, but is the only kind of middle-income market that is really competitive now relative to other developed countries.
Thank you, and I think we've got time for one last question. Christian?
May I? Thank you. Firstly, Annie, thank you for making accounting history interesting. So thank you, Lorena, for not having the UK on the list of socioeconomic impact at all. I looked all the way to the bottom and we couldn't find the UK, which means that perhaps we have a proxy with Rwanda at the bottom, where half of the population will be soon. May I ask a question, please? If you looked at, there's a gentleman here in blockchain, and if we looked at the 2018 report, my role was formerly at Standard Chartered Bank as global head of IP, and then more recently, I chair Fox Robotics, which is a startup in the world of IP and financing. If you were to pick the way to bash through the door of the current inertia, since the 2018 report, which the British Business Bank sponsored and Nigel Schweitzer co-wrote, and I had a wonderful meeting with Pippa Hall about, not a lot has really happened to promote the changes in what we really need, which is to open the door, to stop saying, like the venture capitalists and private equity, we need the first people to be creating a secondary market for IP financing. We need to actually create more incentives, really, to open up those doors, and appreciate that there have been quite a few government and parliamentary changes, so that's been quite hard to move the agenda forward, I understand. And the previous speaker, David Had, at the last session was partly responsible for that, the blonde-haired gentleman. But if you were to push open the doors, could we not do something more to incentivize secondary markets, as we have in Silicon Valley, to actually try to finance and create that secondary market that existed before the fiasco of Silicon Valley Bank. Secondly,
Forgive me, can we? I think we need to.
Sorry,
if we could allow the
very
panelists.
sorry, forgive me. But the question is,
Look,
can we get
Hamza, if you could react to that
Yes, sorry.
first question, and I just want to make sure and then there'll be plenty of time to grab the panelists in the session, in the networking if you do have any further questions.
The WIPO also on accounting.
I mean, maybe really, really quickly. I mean, first of all, just to be perhaps realistic about the fact that IP, there are constraints around IP as a kind of asset class. Just being really realistic about that. But if there are kind of opportunities, I think there are opportunities around the kind of lending space, and the British Business Bank IPO report, which I alluded to, absolutely seminal in my opinion, and kind of provides really, really clear evidence that firms which have IP make better lending candidates, and I think there is some merit in. Well, I think that kind of evidence needs to be better understood, so that banks and other lenders are a bit more receptive to the possibility of IP-backed loans.
Thank you very much, and I think great to hear from both Hamza and Lorena. And you may have more questions for them. As I say, you can grab them in the networking afterwards. Thank you very much, both.
Well, our final speaker is Ashish Babu, who is the CMO for Europe at TCS. We've known and worked together for many years. I'm very interested to hear what you've got to say. Over to you.
Thank you. So I'm conscious I'm between your lunch. I've got 100 slides. We'll run through quickly. Don't worry. We'll have fun. Obviously, I mean, what I'm seeing here is, I'm sitting with all the financial geeks. I'm not. I'm an historian. I think so. My company, which I work, is a bunch of engineers. And everything which we spoke about, innovation, software, healthcare, is what we do. So I'm going to tell you a story, and it's just going to be visuals and some fun, and hope and optimism. That's what I'm going to leave you with, so that there's more food for thought. Okay, that's it. So what you can see is a picture of two people. One obviously looks like an athlete, and one looks like a wannabe athlete. Now, obviously, my size and shape doesn't get me far except for playing touch rugby. But next to me is Des Linden, who is actually an Olympian and a long-distance runner. I met her at a North America summit in September, and she represented US in Olympics in London and Rio. She was the first American woman to win the Boston Marathon. She just broke a record 6 months ago where she did 50K in a record time. She also turned 40. When we talk about life expectancy, turning to 60, there's a woman at 40. She just broke the Masters record at TCS Chicago Marathon. So that's the story I want to tell you about ambition and inspiration. So that's her. No, sorry, this is going to be fun, yeah. So for this, I think, what data is telling us is resurgence of athletes. We as a company sponsor and partner with more than 20 marathons. We're seeing a different generation of people. We're seeing C-level who've seen the world, want to go and run marathons. These all marathons are in the financial capitals. They do one, they want to do more. And that got us intrigued that is there a potential for humans to go beyond just running and have a longevity. So with this, we partnered on something called a digital twin. Now, digital twin has been always there. I mean, as a tech company, we build digital twins for airlines. When they fly and when they land, the digital twin predicts how much oil, how much spare parts are needed so that they can turn around quickly and fly. We're doing that for ships. So for us, we've been doing this across the industries, and we wanted this actually Marvel to come to humans. So there's a project which we're working with Des on can we create a digital heart for her, which is going to help her performance. It could be 10 seconds, 20 seconds. But the impact of this is, if each one of you today can get a digital heart, imagine what's the potential. 60 years, I think you can go to 120 years with all the medical healthcare. And this is, again, we live in the world of innovation. We want to bet on the future, and we want to try impossible. Will we get there? That's the hope. We're working with ecosystems of partners, and I think we're really glad that she is someone who's betting on this. I want to show you just
Imagine you could shave 30 seconds off your time without lacing up. As innovators solving problems around the world, TCS uses digital twin technology to help you rehearse the future. When you have a heart for innovation and belief runs deep, extraordinary solutions are entirely possible. With that kind of power, imagine the difference it could make in your world.
So ultimately, the best technology is here to help humans. We've spoken about innovation, we've spoken about seed funding, but ultimately it's about humans succeeding every day. I mean, our business is focused on helping businesses be innovative, get ahead, and obviously create that impact in the society. As a company, we've seen, in 50 years of existence, we've seen the whole technology cycle. We've seen the world of Y2K, which was zero, which was going to wipe all the computers. We've seen cloud, we've seen AI, and now generative AI. And we go through a hype cycle, and then things settle down. But the hype cycle is what makes people extremely nervous. And what we try to do is create showcases where we can tell a story through that. Ultimately, our clients are global, and they care about three things. They want a sustainable environment. Obviously, in Europe, 2030 is a goalpost everyone's fighting to get to. They want to be digital ready. I think COVID tested everyone. We told them to get into cloud, they didn't. COVID got them into cloud. We told them digital is going to be the next. Now they're looking at digital. But ultimately, the single goalpost is being innovative. You don't know where you're going to be challenged from. You don't know when your next epidemic is going to hit you. So you got to build an agile organization, and that's what we do day in, day out. So I want to tell a story, and this is just 4 slides, so I'll make sure you're out for your meal. So when we took on Marathon as a partnership, we found the most interesting thing. Marathon is a sport you run alone in public. You're the only one running. You don't know if your friends and family are there cheering for you. And we build basically a digital footprint for marathons. So basically, today, if any of your friends are running New York, Chicago, Boston, London, or Amsterdam, you can actually find them in the app through the BIP. You can follow them and meet them at Curry Shark or Pall Mall, and they'll be happy to see you. You want to send them a message? We can enable that. So that's what we've done, is build a whole ecosystem where you have the complex technology of AI and cloud, but ultimately it's about helping humans succeed. I was told to talk about startups. I didn't have financial numbers, but I'm going to tell you, as a company, we have something called the Co-Innovation Network. We have the clients, we have the technology. We bring in the startups because they have the ideas. We get those worlds to collide. And what we create is technology which is going to help marathon runners do better. So we're talking about generative AI, which is last year. AI was already there in 2019. It was behind the scenes. It was already working and helping you. And we created an app which was about training your personal trainer through an AI. NFTs, people got excited about NFTs. We built smart medals, because again, it's a show and tell for us. Television viewing is the worst when you watch a marathon, because if you watch on BBC, you're basically dependent on the commentator to tell you who's going to finish first and last. What it didn't have is stats like Formula 1. And that's what we added in that, working with a startup. And lastly, I think what we figured out was these are big events, and they have a massive carbon footprint. And we needed to ensure that we have a goalpost but our partners also have a goalpost. And we actually worked with the Council of Responsible Sports to build an app so that people could measure the carbon footprint. And lastly, this is a new partnership. Our clients are asking us, EV technology is going to be explosive. It's just not about supercharge. Logistics companies who have space want to build more EV charging facilities. I live in Amsterdam, where there are more EV cars, less places to charge. So now we're thinking, can everybody become a grid provider? Can you provide EV service? So this is one partnership, which is again ahead of the cusp. And this is the only sport in the world which is net zero. So we want to learn from the best. Sorry. But I think the most important thing is, these platforms obviously work in isolation. We want to collide the world. Our clients want to learn from each other. The banks want to learn from retail wants to learn from utilities. So what we basically do is get our partner ecosystem together. On the left side, the lady in blue suit is head of sustainability for Formula E, Julia. In the middle, next to her, is Santino, who is the head of partnership from Jaguar. And in the middle is the man, Hugh Basher, who runs London Marathon, London events. And each of these are having a conversation, and nobody gets up thinking sustainability is the most exciting thing. We want to make sustainability fun. We want to make sure people can share. So our whole inspiration comes is how sports can teach businesses to be sustainable. So I'm going to leave you with our last story.
Europe, home of the world's most ambitious climate goals. Across the continent, we're driving change. In our own operations and those of our customers, slashing emissions through smart tech, harnessing data for positive impact across sectors and borders. Reimagining everything, from motors to marathons, to ease the burden on the planet. Our efforts haven't gone unnoticed, but much remains to be done, because through the twin forces of innovation and partnership, we can lead the world into change, together.
So I just want to end with, if we can succeed with this, Linden, look at the impact on healthcare. And that's what we do, disrupt, through innovation. And that's what everybody spoke about, intangible and innovation. That's our life. Thank you.
I've just got a couple of little things to say. First of all, thank you all for coming and staying and being engaged. I hope you'll stay for something to eat. Secondly, this is the first of a series of brand finance forums, which will run through until March next year. For anybody who is going to be in Davos, we're going to go there. I thought I'd brag about that. We go every year, and it's really quite a blast, and it's great for actually getting the message out. So Davos will be one step, and then in March we'll be doing something similar to this, around similar topics, I think, because I think one of the interesting things is that the examples that we've heard during the morning bring to life the whole discussion about intangibles and brands far more than just talking about the global intangible finance tracker and what the number of value of assets is. It's seeing real life experience of problems of financing and developing brands. There are two very specific things I'd just like to mention. One is that I saw that our colleagues from Legal and General Asset Management here earlier. I don't know whether they're still here. Is anyone here from Elgin? They had to shoot off. Well, somebody that used to work for Brand Finance years ago, who was their strategy director, approached us and asked us to assist them in creating an index based on the performance of brands in the Brand Finance 5000, which is the 5,000 brands that we value every year and that we provide to the World Intellectual Property Office. They took the top 500 and they've analysed that to show the performance of the relevant companies on stock markets. And the analysis that was done by a German firm who specialises in developing these indices demonstrated that the stronger brands in our tables resulted in outperforming the S&P quite significantly. That has been incorporated into an index which LGIM, I think they call themselves now. LGIM recently launched and they are now acquiring assets. Now, they've got very small assets under management at the moment, but we hope it will grow. And we're led to believe that it might, because there's an American fund, is it Morgan Stanley? They've got 20 billion under management invested in strongly branded assets. Now, the reason I mentioned that is, well, obviously we'd like it to grow as a thing under assets under management. But should it succeed and should it demonstrate an outperformance, it's a very good way of communicating to the market that strong brands do actually outperform. And that's the message we're trying to get across to people, so they will invest in all this stuff. Now, I do think there remains a very strong reservation amongst finance directors generally, financial communities generally, that all this, if invisible stuff does actually have a value. Now, I think one of the things that companies can do to be able to demonstrate that more clearly is to segregate the IP. And over the years, we've worked on quite a number of intellectual property co's or brand co's where the assets are actually taken out of the operating business. And for example, the hotel business works exactly this way. They take the IP out, they put it into a separate company, and the separate company then licenses its IP to other companies. Now, in those situations, you can see very clearly the value that's arising, because there are two parties. There are the parties operating, there are parties owning. And from my experience, I think those IP co's represent a very good way of reassuring investors and lenders that this imaginary, invisible stuff does actually have a value. So on the one hand, the investment argument, I hope, is getting across. On the other, the demonstration that these assets can be worth a lot of money will get across, and hopefully that will convince CEOs and finance directors of many more companies that it works. Now, when Brigitte was talking, she was talking about the investment behind the LSEG campaign. One of the interesting things I thought about that was the comparison between Fever-Tree, where Ollie was saying that it was boom and wonderful and the journalists were all on top of it to start with. And then when things started going a bit rockier, they jumped in with all those nasty headlines. In some ways, the LSEG group has the same issue, and all B2B brands have the same issue. They need to spend more money promoting their brands, getting their message out, and making sure that their message is the one that gets across. Because otherwise, you're drifted along by whatever the vagaries are of journalists who may or may not understand and may or may not actually care whether it's the correct story to get across. And so what that says to me is that B2B brands as a whole need to be communicating. And I would say if LSEG does not allocate a budget in the third year, they are probably making a mistake. They probably need a budget in perpetuity of whatever amount. But we'll wait and see a year or so from now whether they buy that argument. But I firmly believe that B2B brands need to build their brands at least as much as B2C brands. So really, that's all I've got to say. I hope you'll join in the conversation. We will actually, if it's okay, send you a feedback form. I'd be interested to hear what you think about all the contributions and suggestions for the future, how we could improve it, because I want to carry on doing these events over the next year or so. So thank you very much for coming, and join us.